Ladies and gentlemen, it is with great pleasure that I welcome you to this event, the Joint Audit Day, here at the Petit Auditorium of Palais Brognard, or virtually on E3C's YouTube channel. I'd like to give a warm welcome to our esteemed colleagues from South Africa and Bulgaria who have shown an interest in working with E3C on the preparation of today's event and will very significantly contribute to the debates which will take place today. The common characteristic of our three countries is that we apply joint audit to some public interest entities. As you have certainly noted, the European Commission launched on 12th November a public consultation which topic is corporate reporting, improving its quality and enforcement. This consultation raises, among other things, the question of applying mandatorily joint audit to categories of public interest entities, and in this context, today's event is particularly topical. However, it is to be acknowledged that joint audit is not frequently applied in major financial markets. And one country, Denmark, when joint audit was compulsory in the past, abandoned it in 2005. Therefore, there is a need to discuss the pros and cons of joint audit and to engage in a debate which will allow to clarify a number of areas. Possible reasons for the failure of joint audit and measures which can improve its efficiency. In order to achieve this, today's event will offer several panel sessions and presentations which will cover the following subjects: the framework put in place in countries where joint audit is applied, the way all stakeholders involved in the production of high-quality financial reporting interact in the context of joint audit, the link between joint audit and improved audit quality. We will have contributions from corporate entities, audit committee members, auditors, financial markets and banking supervisors, and audit supervisors. We will also benefit from contributions and questions from guests coming from countries where joint audit is not applied, and from Professor Marnet from the University of Southampton, who will present a summary of his research on joint audit. Attendees, whether on-site or via electronic means, we have the opportunity to raise questions. Today's event will be recorded and made accessible on E3C's website. I wish you a very fruitful event. Patrick? Patrick, I'll give you the floor, maybe for Jacques Etenvenin. Thank you.
Thank you, Mrs. Pebernes. Good morning. My name is Patrick Parent. I'll be the timekeeper today and also a facilitator at some of the sessions of today's event. I'm the senior advisor to the chair of E3C, and I'm also a former market regulator, and auditor. We will start today with the first session dealing with audit standards and other guidance that has been provided on joint audit. Jacques Etevenin, who is a member of the board of H3C, also the chair of the commission in charge of establishing auditing standards in France, and a member of the International Monetary Fund External Audit Committee and former deputy finance director of the Air Liquide Group, will be the facilitator for this first session. We'll have contributions from Ms. Valia Jordanova, who is head of the Advisory Council on Auditing to CIPOSA. CIPOSA is the audit regulator in Bulgaria. Ms. Jordanova is a certified public accountant and registered auditor and a member of the Institute of Certified Public Accountant in Bulgaria. She is also the chairwoman of the Advisory Audit Council to CIPOSA. And Ms. Jordanova has been involved in the development of the Joint Audit Guidance Statement of CIPOSA and ICPA in Bulgaria as a project coordinator. We will also have the contribution from Jan Mtega, who's a professional manager of standards at IRBA. IRBA is the Independent Regulatory Board of South Africa, the audit regulator of this country. And we will also have contributions from Marjolaine Doblado, who is director of the International Division of the French Audit Regulator, H3C. In the interest of time, I will...
Excuse me, I can't hear.
Miss Jordanova? Can you...
I'm very sorry, I can't hear.
Okay, we'll try to fix that.
Okay.
Jacques, I give you the floor.
Okay, thank you, Patrick. Good morning to all of you. For me, it's a great pleasure to moderate this panel on audit standards and other guidance. We will make you the technical presentation on joint audit with the experience of 3 countries. So the purpose is to explain how joint audit works in those countries and also to compare and to identify similarities and differences. So maybe to start, I'll ask to the panelists, the distinguished panelists, 3 questions about the rules managing joint audits. Question number 1, is joint audit mandatory or optional? Question number 2, what is the scope of joint audit? Does it concern only listed quantities, specific financial entities? And does it concern all financial statements published by a company or only parts of those financial statements? So maybe, Valia, could you start for Bulgaria to answer to those 3 questions, please?
Good morning, everyone. It's a huge pleasure for me to be able to present Bulgarians' experience in the field of application of the joint audit. Even more so because we are one of the few countries in the European Union that have taken such a step so far. Joint audit was introduced in 2017 together with other significant amendments in our Independent Financial Audit Act to adopt the Audit Directive from 2014 and the Regulation 537. So far, the joint audit is limited to only 3 types of entities in Bulgaria. It is mandatory for the statutory audit of the separate and consolidated financial statements of banks, insurance companies, and pension companies and funds. However, it's not mandatory for the statutory audit of the separate financial statements of their subsidiaries and associates. Joint audit is not mandatory in Bulgaria for the statutory audit of the annual financial statements of listed companies.
Thank you, Valia. What about France, Marjolaine?
Yes, thank you for giving me the floor. So in France, joint audit is in place for longer because it has been introduced in 1966. Nowadays, it is compulsory for some entities only. It is required for those entities who publish consolidated financial statements. So it's not a question of being listed or not, it's a question of establishing and being required to establish consolidated financial statements. There are also some provisions that are specifically applicable to credit institutions. So unless the credit institution is under certain thresholds, all credit institutions are also required to have joint auditors. So as was mentioned, indeed, I think it's the same in Bulgaria. It's the entity at the top of the group who has to appoint 2 auditors at least, which means that the subsidiaries have not this request to have 2 auditors. It's the entity which publishes the consolidated financial statement, which has 2 auditors. And then regarding the question whether it's the individual accounts or the consolidated accounts, it's the entity who has 2 auditors. So both the opinion on the individual accounts and the opinion on the financial consolidated accounts are co-signed by 2 auditors. I think I covered a bit the general picture. Maybe over to Jan now.
So Jan, what about South Africa, please?
Thank you, colleagues, and good morning. So from our perspective within the South African environment, the joint audit is not mandatory. What happens is the regulator of the banks, of the South African Reserve Bank, issues a directive or an instruction, so to say, on an annual basis, requesting the big banks to have joint auditors as their auditors from each financial period. In the old days, it used to be in the Banks Act, but that was removed. So now it's at the discretion of the regulator, so to speak, the banks regulator. And then in addition to that, we do have currently a discussion around making a similar requirement where the regulator issues instruction for the insurance companies, so for our big financial services companies. Thank you so much.
Thank you, Jan. So we've got an overall picture about the scope of joint audit, what type of companies are concerned in the different countries. But there is a main question that we need to ask: what is a joint audit? Then maybe Jan, could you broadly explain how a joint audit is structured in principles, just the principles, and we'll go into more detail later on, but in principles in South Africa. And maybe then I will ask Valia and Marjolaine to explain, based on what you will have said, the differences in Bulgaria and in France. So what are the principles and how are they stated, in the standards?
Thank you so much. So yes, in South Africa, as you know, we adopt the international auditing standards. So that's the principle that we use in terms of performing any audit. So when it comes specifically to the issue of the joint audits, then if I start at the end in terms of the audit report, what happens is there's one audit report signed jointly by the joint auditors. So that's the end goal. To arrive to that end goal, we expect the joint auditors to work in tandem and go through the standards in terms of acceptance, the performance of the procedures, concluding jointly as they go through that process to arrive at that joint audit report that they will issue at the end. I'm not sure whether there's any additional aspects you want me to cover, Chair?
Jan, is there guidance? Are there, specific auditing standards in South Africa? A book, rules stating how the auditors should interact together to arrive to the joint opinion?
100%. So using the ISAs as the benchmark, we do have a guide which we issued in August 2020, which helps the auditors to essentially, because remember the ISAs don't cover joint audits in detail, so then the guide helps our auditors to practically put into practice what the ISAs are saying in relation to a joint audit, because the ISAs are written for a single auditor engagement.
But does it mean that it's just how you apply ISAs in a joint audit structure? That's basically what you've developed in South Africa?
Yes, at this stage, because of the fact that the joint audit is not sitting in any legal requirement, the only place we could use is we needed to stick to the ISAs. So we use the ISAs and we practically show the auditors how they can comply with the ISAs in doing a joint audit engagement, 100%.
Okay. In Bulgaria, Valia, do you have specific auditing standards explaining the rules to follow in a case of a joint audit?
Well, in Bulgaria, we have similar concept of joint audit. In fact, we also introduced this in Bulgaria as national standards since 2003. And 2007, when the joint audit was introduced for the first time, the oversight body, Commission, and the Institute of Certified Public Accountants, we set up a work group and, in fact, surveyed the experience in other countries, mainly France and Singapore. And based on this, we developed a joint document, a joint audit statement. In addition, in fact, the document focuses on the organization and approach in the work of the joint auditors, and not on the methodology, because we apply ISAs in Bulgaria, and also it focuses on the communication between the joint auditors and the regulators.
Thank you, Valia. Marjolaine, maybe can you comment on what we do in France?
Yeah, in France, maybe what's important to note is that the two auditors form part of a college and act together as the statutory auditor of the company. So they should apply together the provisions of the national standards that are applicable for each and every audit. But in addition to that, there is a specific standard which deals with the distribution of the work between the joint auditors and explains how they should act together. The principle is that the standards apply to the college, and the specific standards explains how the work shall be distributed. This is also something that is foreseen by the law directly. There is a provision in the law referring to the fact that there is this standard which governs the way to carry out the assignment in this specific format, which is the joint audit format. But in the end, all the provisions of the national framework shall be applied by both auditors together in a way that is distributed according to the provisions of the national standards. And indeed, as was mentioned by your colleague from Bulgaria, we had some interaction with Bulgaria at the time to inform about how the distribution of work was performed in France.
Very clear. Thank you, Marjolaine. So if there are standards, it means there is role and responsibilities of joint auditors. So I'd like to, to understand, how the joint audit is organized between the two auditors, and what is the role, what is the split of the work, is it a 50-50? Is it, certain, in a consolidated group, certain subsidiaries and others done by the other auditor, or is it purely, totally joint work? So that would be my first question. And relating to that, if one of the, what are the responsibilities of the auditors vis-à-vis the management of a company, vis-à-vis the shareholders? Is it a joint responsibility? Is it a split responsibility? And what happens in case one of the auditors does not perform a good job? One does a very good job, the other one does not. What happens? So could you maybe, Valia, maybe let us start with Bulgaria, explain how all the role and responsibilities are organized in the joint audit?
In fact, one of the most valuable feature of joint audit in Bulgaria is the joint and several responsibility for the audit, which means that each joint auditor is jointly and severally responsible for the audit performed together with other joint auditor. As well as for the auditor's opinion on the audited financial statements. Each auditor is responsible for the work of the other joint auditor and cannot claim limited liability due to the negligence or low quality of the work performed by the other auditor. Also, in our legislation, we have a specific joint auditor selection criteria, and these criteria were developed and introduced by the respective regulator. In addition, each joint auditor must possess the appropriate and required by the respective regulator competence, specific knowledge, experience, and also resources. And in this statement issued by the Commission, it stated that joint efforts for cooperation and non-restricted access to the audit documentation of the other joint auditor are required. If we have to summarize, in fact, it's a really joint work, shared work, and joint work at the phase of planning, acceptance of the audit engagement and audited entity, and at the phase of completion. So the joint auditors has to do jointly the work, starting from the individual or joint submission of an audit proposal. So it means that in Bulgaria, both approaches are possible: individual participation in the tenders, or jointly the two auditors. And then jointly responsibility for observing the statutory independence requirements and other requirements and restrictions by our audit legislation in Bulgaria. They have to coordinate the procedures, and they have joint responsibility for acceptance and assessment of the audit client, audit engagement, and they have to sign a joint engagement letter. So for the areas like planning, risk assessment, significant matters, both the joint auditors are responsible to get participation. In fact, only on at the stage of execution, we have share of work. So it means that we have allocation the work between the two auditors, but in our guidelines, the Commission, in fact, introduce a certain proportion limit between the two auditors for the significant risk, 60 to 40. And in fact, finally on the completion session, so they need to assess all conclusions and final results and evidence together and to reach joint auditor's opinion and to sign a joint auditor's report.
Valia, just a question. If there's a disagreement between the two auditors on the opinion, what happens?
In fact, we have no such case up to now in Bulgaria, but in our legislation and in the guidelines they allow a situation of differences in opinion, and there are some requirements for necessary steps like early identification of differences of opinion, procedure for dispute resolution, communication regarding contentious matters with the management and with the audit committee of the audited entities. But if finally there is a disagreement, so according to our Audit Act, in the auditor's opinion, in the auditor's report, each of the two auditors should state their opinion and arguments thereon provided by each of these two auditors in a separate paragraphs. So finally, they have to issue a joint report with a separate paragraphs.
Based on what Valia has told us, I see there are a lot of, we see the contacts which existed a few years ago between France and Bulgaria, because we see a lot of similarities between what you have said and what happens in France. But maybe Marjolaine, can you comment about maybe some differences which exist in France compared to what Valia has told us?
Yes, sure. Yes, I think indeed. In the end, the same results is expected, meaning that there is only one report. So the idea is that the two auditors sign the same opinion, not going directly into any difficulty or conciliation need, and if there is a difference in view, which is not, I would say, the main situation or the one that is the most seen. But indeed, in our national standard in France, there are also some provisions for potential conciliation between the two auditors. The idea is really that they are able in the end to sign the same opinion. So if we go back to the main provisions, what is interesting in the standard is that there are a number of elements that have to be performed by each of the auditors in order to be able to form his opinion on the financial statement taken as a whole. It's not a question to have only an opinion on certain areas of the audit. No, in the end, the auditor should have the global picture and be able to participate fully and take responsibility indeed for the final report. So what are the work elements that should be done by each of the auditors? It's first understanding the entity. Each auditor shall have the complete understanding of the audited entity. He shall be also able to assess the risk and to assess materiality in order to come up with an audit plan that is agreed and that is decided together by both auditors. So the joint audit plan is discussed and agreed, of course, together by the joint auditors. And then what is split, and I think Valia mentioned it's the same for Bulgaria, then the field work can be divided between the auditors. It's not a question that all the elements are audited twice. No, of course, the work is split, and the results of the procedures are in the file of the auditor. And after that, there is the need for a cross-review. So the cross-review is an important aspect where one auditor that has not directly performed the fieldwork can have a look and review the conclusions of the other auditor. And so in the end, each of the auditor has the complete picture and knows exactly what has been done on each section of the work.
We'll address maybe this question a bit later. We are more just on the question of engagement, and how it is organized. Jan, based on what you've heard for Bulgaria and for France, do you have major differences in South Africa and how the joint audit is organized between the two auditors?
Thank you, Chair. Yes, from what my colleagues have stated thus far, there's quite a lot of similarities. So for the South African environment, again, similar to what the colleague said, a joint auditor has a joint responsibility with the other joint auditors for the audit and the other joint auditor's opinion that is expressed by them on the audited financial statement. So everything is you almost look at it, my colleague Marjolin used a very nice word earlier on college. You look at it almost like a college, even though it's two different firms or more than one firm. But when they do the work together, you look at them as one. So that's the joint responsibility. A joint auditor's joint responsibility means that the joint auditor is also responsible for the work performed by the other joint auditors. And they shall therefore jointly ensure that the joint audit engagement is conducted in accordance with the ISAs or the International Auditing Standards, and that sufficient and appropriate audit evidence which you can evidence through cross-review is obtained and documented collectively by all the joint auditors in order to express the joint auditor's opinion. So that, in practicality, that means you have this scenario where the documentation is sitting in two different audit files, electronic audit files in one firm and the other firm, but together, then that's the entire file for that particular joint audit engagement. So in our guide that we issued in 2020, in August 2020, we gave guidance to the auditors to say, because the mechanics, how you actually apply the ISAs is a bit difficult, we propose that the auditors then have a joint auditors agreement. So in other words, between the auditors themselves, they must have a contract, and that contract will cover some of the things that my colleagues were speaking about. So the contract between the auditors themselves will cover the policies to be applied in respect of independence and or compliance with the relevant ethical requirements, agreements on monitoring arrangements, agreement on group audit arrangements, who's going to audit which entities, which subsidiaries, although you do, the cross reviews, etc. Arrangements for relevant joint induction and training of the teams coming from both all the joint auditors, the joint auditors' respective roles and responsibilities with regard to the joint audit. So the roles and responsibilities then will be covered in the joint, in the agreement between the joint auditors. So those are some of the things that we put forward there, as well as one important aspect which Marjolin also spoke to a little bit earlier on, the allocation of the work. So the allocation of the work to each joint auditor will then be covered in the agreement between the joint auditors. Thank you, Chair.
Jan, can you have an imbalance between the work of the two auditors, or should it be a 50-50 allocation of the work?
So in terms of how we have drafted it, you can have a scenario, because when we discussed it in drafting our guidance, we thought it's very difficult to have a 50-50 split. So you might have an imbalance, but the check is the cross review. So even if one is doing a little bit more work, the other one still has to cross review, and that's how we are comfortable that both of them are able to sign off as the joint auditors on the joint auditors report.
But the imbalance is marginal, you say, if I understand well. It couldn't be 90-10, for example. It could be 60-40 or... Okay. I'd like
100%.
Okay. I'd like to pursue on the point that Jan has already addressed about the formal agreement between auditors. So I will ask Valia and Marjolaine how it is done in Bulgaria and France, but I've got also a question to Jan before we go to Valia and Marjolaine. The agreement between auditors is the company, the company which is audited, is it aware of the components of the agreement between the two auditors? The split
Yes,
of work, who does what, how the audit organized, is it shared with the company which is audited?
Yes, 100%. Usually, most of the times, the company, the management of the company gets involved in the allocation, but to manage the actual audit work, then the two auditors will also need to have that mutual understanding or agreement between themselves to ensure that the work is done, simultaneously as well as in a synchronized manner. Thanks, Chair.
Just and after that, I'll pass to Valia. In the split of work, is there any obligation of rotating the work from one year to another, or are the auditors completely free, basically, to continue to audit the same components of the accounts of the same subsidiaries, or is there any obligation in the organization of the work then to change 1 year after another one?
100%. Very good question, Chair. So in our respect, we don't have a mandatory requirement, but we do have a suggestion in the guide that they must rotate the work amongst themselves from 1 year to the next. And then we also do put a suggestion for the management of the entity also to request that there's a rotation, because I think it's better that you have different eyes looking at the actual work, although you still have the cross review that will happen at some stage between the joint auditors. Thank you, Chair.
Okay. So Valia, can you comment about the engagement letter, the negotiation of the engagement letter, between auditors and maybe the company in Bulgaria?
Well, in Bulgaria, we have a joint engagement letter assigned between the joint auditors and the audited entity. We have no such practice to sign a formal contract between the two joint auditors, so there is no such practice. In fact, the organization of the work between the two auditors is based on the internal communication, because in our guidelines, they are mandatory requirement for joint development and approval of the overall audit strategy, audit plan, also assessment of independence. So we have to have a joint common materiality level, common threshold for uncorrected misstatements, and also a common understanding and approval of all audit samples. So, in fact, this allocation of the work between the two joint auditors has to be presented and approved by the audit committee. Also, this allocation is communicated with the management of the audited entity. And in fact, the audit committee, this is the body which in fact controls the proper allocation between the two auditors, the necessity of some rotation, which is not mandatory in Bulgaria. Of course, that's why the focus on the cross review between the two auditors, and also the exchange of working papers. Somehow this is also encouraged between the joint auditors.
Marjolaine, for France?
I think one of the aspects that would need to be underlined here is that the engagement in France is for 6 years, meaning that indeed in France an auditor is appointed for 6 years. He is appointed as auditor not necessarily as joint auditor, because, for instance, if you have a company which at some point in time has the obligation to establish consolidated financial statements, then it can be that there is already an auditor in place and that the company will appoint a second joint auditor. So it's the company who will then select the pair, because there will already be one auditor in place and another joining with a specific engagement in this regard. So there is not any provision requiring a joint engagement letter. So that's the responsibility of each of the auditors. But of course, in order to be able to indicate which will be the level of engagement, which will be the work that will be performed, etc. There need to be coordination beforehand between the auditors. There is another point that you mentioned, Jacques, about the rotation of the work and the distribution of the work over the years. Indeed, with this engagement lasting 6 years, over the years there is a possibility for auditors to switch and to take other areas of the audit under their scrutiny for the field work. So the idea is really over this 6-year period that there is a possibility for the auditors to change the topics on which they will be more specifically involved for the field work.
Thank you, Marjolaine. We've already touched the subject. It's about review of the work done by the other auditor. What happens if one auditor sees that the work performed by the other auditor does not seem sufficient for him? And so maybe he considers that one auditor considers that additional work should be performed. Is there any rule to follow for this, or is it just a question of discussion between the two auditors? Jan.
Thank you, Chair. So in totality, it's essentially a discussion that should happen between the two auditors. But the principle that we use for our purposes is that the joint audit report must be jointly signed. So that's the responsibility we allocate to them. How they do it amongst themselves, we give them a bit leeway how they make their arrangements. So in that particular instance, what would happen is the joint auditor that is not happy with the other joint auditor's work would probably request that joint auditor to either do additional work or redo some of the work, so you can either review or cross-review. If the other joint auditor refuses, then the one joint auditor can perhaps do the work himself or herself. And then alternatively, if there's still a dispute, then you will have to go to that agreement between the auditors that I spoke about earlier on. Then in there, you will have a dispute resolution as to how you resolve those differences on how the procedures were conducted or the samples were performed, so to speak. Thank you, Chair.
Is the company, if there is such a dispute between auditors, is the company, or the audit committee of the company, are they involved or not? Or is it a question of just the agreement between the two auditors?
Yes, when we discussed it in drafting the guide, we thought if it gets to the audit committee, then you probably go into the scenario where it's no longer a joint auditor's report anymore. You get into the scenario where maybe the audit report now they want to issue different audit reports. So in our thinking is that the dispute should be able to be resolved between the auditors themselves, and then if you can't, then you go to management. And then the audit committee for us was, in our thinking, it should be a last resort. Because for us, when you get to the audit committee, we're probably speaking about split opinions, those kind of things. And then that's no longer a joint audit report for our purposes. Then you're actually almost going into a single auditor report, so to speak. Thanks, Chair.
Okay. Valia, on your side?
Well, our practice is very similar. In fact, if as a result of the cross-review of the work performed by the other joint auditor, the other auditor concluded that the sufficiency and appropriateness of the audit events are not enough. So they have to have internal communication, and the joint auditor has to recommend for some additional work to be done. But if the other joint auditor refuses, so in our guidelines, we recommended that the other auditors has to perform the additional work. Of course, it's a matter of their internal communication and decision to address this matter, this problem, to the audit committee. It's not a practice to be discussed with the management of the audited entity.
Okay. Marjolaine?
Yeah, for France, indeed, the cross reviews allows to make sure that the work that was planned at the beginning has been carried out, and that there are not surprises that need to be addressed. And the idea behind the cross review is that each auditor is comfortable with the work that has been done. And indeed, there are some provisions specifically in the standard dealing with the fact that if after the cross review there is the idea coming through that the work is not sufficient, then there is a consultation between both auditors, and they define together which additional work need to be performed. So the idea is really that there is this discussion, this collegiality to decide what needs to be done further. But as a principle, we hope that the first plan was a good one, and that it has been carried forward correctly, and that the evidence is there. So in bad situation, of course, there need to be some refining of the work, but that has to be done together. And as is important to note, it's in the end the collective opinion of both of the auditors, so they should both be comfortable. So after discussion, the work needs to be done and then distributed again amongst both auditors.
There are two other topics I would like to cover, before the end of this session, and maybe give us some time at the end for questions. So two topics that maybe we'll try to cover a bit quickly. First is documentation. What are the rules for that the auditors have to follow to justify that the work has been performed and that the joint auditor has also performed the work he was supposed to perform? Does it mean that, and in case of a control by the regulator about the quality of the audit, does it mean that there is a duplication of all the files? Or does it mean that auditors have only to keep the files on the work they've performed, and the joint auditor keeps his own files, and there is just documentation on the cross reviews? Could you just explain what are the rules for documentation? Valia, maybe could you start this time?
In Bulgaria, in fact, each joint auditor must have their own complete audit file, which is in accordance with the requirement of our audit legislation and the applicable auditing standards, which are ISOs, and of course their own internal methodology and policies. In fact, in this audit file, the audit file should include documents on the cross review, reviews between the two joint auditors, as well as all other joint documents regarding the key matters which the joint auditors have made their joint assessments, judgments, conclusions, decisions, including for the independence, for ethical matters, for audit planning, audit completion, and the audit opinion. So whether they would exchange their working papers depends on the internal negotiation between the two auditors for the way, but these documents for press reviews, they have to describe the reviewed documents, and some joint protocols has to be signed for such cross reviews. In addition, each audit file, so each joint audit engagement is a subject of a separate inspection by the Commission, and also each joint audit file is a subject of the internal independent quality review required by our legislation.
Very clear. Jan, what about South Africa on documentation?
Thanks, Chair. So on documentation, or the overall, the principle that we use is that although the work itself might be sitting on different electronic files, we view it as one. So the important part is actually the cross review that will have evidence here to show that I looked at another file. That's indicative of that the whole entire file has been looked at. So that's the main principle. In terms of the mechanics, so the audit file in the context of the joint audit engagement consists of each joint auditor's documentation relating to their agreed allocated audit work and the documented evidence of the cross review. Collectively, the joint auditor's documentation forms the audit file. It is not expected that all joint auditors would retain a copy of all engagement documentation. So we don't expect you to copy what's sitting in the other joint auditor's file and put it in your file as well. No? We see both of them together as the entire joint audit file. Okay. However, the joint auditors are allowed to agree to, if they can, to have a single audit file or electronic file if they're able to do it. But it's not a requirement. Thanks, Chair.
Okay. Marjolaine, I think in France is very similar.
Yeah, I think Jan has covered quite well the situation. Indeed, the provisions on documentation apply to the college, so the file should be in the end complete, taking both parts of it. And in addition, of course, each joint auditor should document the cross review that he has performed and the key elements allowing him to form also his opinion. So the idea is really that in the file of each joint auditor, there are the elements supporting the opinion that will be delivered in the end. But the idea is not to have a full duplication of the files, but appropriate documentation. And there is one specific provision in the joint audit standard to explain indeed that the supporting documentation shall be retained by each auditor.
Last topic before questions. It's communication with management. It's something we've addressed, during the discussion. We've, addressed from time to time this question. But just just to summarize, how is the communication organized with management and with the audit committee, I should say? Is it always a joint presentation by the auditors, the joint discussion, or can we imagine that the auditors talk individually, to management, to audit committee on certain topics relating to the joint audit? Jan, maybe?
Thank you, Chair. In the South African environment, our guidance suggests that the auditors must do it jointly. So all communication to management must happen jointly. All communication with the audit committee must happen jointly. You can have a scenario, obviously, because one has audited the work and the other one has cross-reviewed. So the one who did the actual audit work will then do the drafting of the document, and the other one will just ensure that he's aware of it, and when it's presented, he's present. Because then that keeps the principle of a joint audit engagement. Thanks, Chair.
Very clear. Valia?
Well, our guidelines envisage for the entire communication between the joint auditors and the management, and the communication between the joint auditors and the audit committee to be performed jointly. So it means that all letters, all reports has to be prepared and signed and presented jointly.
Yeah.
That's the role.
I think it's the same principle that is applicable in France also. The requirements for communication with those charged with governments, so also with the audit committee and with management, are done together by both auditors. So that's really the idea that the two works as a college, and that the provisions of the standard with regard to communication apply for both auditors together. That's the principle.
Patrick, I think we've got a few minutes for questions, if any. Need for precisions.
I think we've been very clear. We have no questions.
Very clear.
I think.
Thank you very much, Valia. Thank you very much, Ian. Very clear. I think it was very demonstrative presentations, very interesting and very interesting. I think we've seen a lot of similarities, between the three countries. It's not exactly the same. Probably there are more similarities between Bulgaria and France than with South Africa, but I think Valia explained why. And I think also what is important, the three of you use the term, it's working as a college, a team, the joint auditors. It's not 1+1, it's really two auditors working together. And that's probably the main message that we can draw, from this session. Okay, thank you again.
Thank you.
Thank you.
Thank you very much, Ian and Valia. And also thank you, Marjolaine and Mr. Etevenin. As planned, we have a coffee break that is awaiting you, and we will come back in this room at 11:15. This second panel session of the Joint Audit Day event. Let me introduce to you the participant to this panel session. We will have representatives of audit firms, of companies, corporate entities, and also of audit committees. Let me first present to you Mrs. Silvia Dinova, who has more than 15 years of experience in the field of financial audit and international audit. She has been head of assurance of the assurance department at Grant Thornton in Bulgaria. She also was a member from 2016 to 2019 of the technical expert group of EFRAG, which defends common European interests in the application of IFRSs. She is a member of the consultative group of auditors with the Committee for Public Oversight of Professional Accountants, CIPOSA, the audit supervisor in Bulgaria. We will also have contributions from Mr. Apostolov, who has more than 26 years of experience in auditing. Since the creation of the company in 1995, Mr. Apostolov has been the managing partner of Grant Thornton in Bulgaria. He has also provided assurance to a number of financial and governmental institutions in Bulgaria. And he has participated as a key expert in advisory projects and reviews of banks, insurance companies, and other public and private institutions in Bulgaria and in Eastern Europe. As a third representative of audit firms, we will have Eric Sevos, who is a chartered accountant and statutory auditor in France. He's the group partner in charge of the audit department at BMNA. He is experienced in the audit of unlisted SMEs and of listed companies, including large groups, as well as mid-cap companies. Let me present to you the representatives of corporate entities and audit committees. For audit committees, we will have the contribution from Mr. Kostov, who is chairman of the Bulgarian ICPA, the Institute of Certified Public Accountants, and also a partner, managing partner of an auditing company in Bulgaria. But Mr. Kostov will present the views of audit committees as chairman of the audit committee of Raiffeisen Bank, Bulgaria. The other representative of audit committees is Mr. Lepas de Sécheval, who is at my left, who is the Executive Vice President and General Counsel at Veolia Environnement, a large listed company in France. He is also a member of the board of the AMF since 2015. We will have the contribution of listed, or not listed, but corporate entities, sorry, with the contribution from Mr. Alain Auger to my left, who is a member of the management board of Bayer Press, and after a first career at Aerospatiale in the finance department, has joined Bayer Press in 1984, where he became the managing director of the group and has been a member of the management board since 2009. So let me describe briefly the objective of this roundtable. We have seen with the first session the rules and guidance that are put in place in 3 countries where joint audit is either compulsory or practiced on a voluntary basis. It is important, in our view, to have a look at how joint audit is put in place, how it is practiced. So we will go into a more practical implementation of the joint audit. And one way to address this issue is to look at the way the communication takes place. So our first discussion will be aimed at the discussion between the joint auditors. I would like to invite the representatives of audit firms to explain to us the type of communication that they have with the joint auditor, maybe starting with the initial phase of the engagement, the preparation of the audit work. And for that, I would invite Mr. Apostolov to talk about his experience in Bulgaria. Mr. Apostolov?
Thank you very much for this invitation. And I think that this kind of events, it's very important for the future of our profession. And I want to present my colleagues here at DINUA to present our report. And after that, to continue with some kind of discussion. Thank you.
Hello, everyone. You have already heard that in Bulgaria we have guidelines. And according to these guidelines, we have to go through several steps during the planning phase of the audit, which include having discussion with the joint auditor team of the other audit firm that is taking part in the audit. And this planning stage is finalized with a joint audit memorandum in which we have a detailed audit plan and audit procedures to follow. But before we get to this final result of the joint auditor's efforts, let me start with several hacks and practices that have turned successful during the planning stage. So one of the essential part of having good streamlined audit processes to identify the points of contact from each of the joint audit firms. These are the, let me call them relationship managers that undertake all the communication and big flow of information which is going to follow during the next phases of the audit. So we start with discussing a list of requested information, and usually one of the audit firms prepares the list of information, and the other audit team adds items to the list. Essential step here is to determine how files will be exchanged, both between the joint auditors and also between the auditors and the audited entity. And of course, the necessary step here is to extract from our own audit programs the audit risks and the planned audit procedures. Let me divide the approach here. If we are working with big four companies, we usually take their audit program and we add some procedures to our own audit program if necessary, so that we can match what is expected in terms of nature, timing, and extent of the audit procedures. If we work with other audit firms and smaller local audit firms, we usually in turn extract from our audit software what we have planned as audit procedures and sit and listen to the other joint auditor who can also propose additional risks or procedures that they think are relevant. So this is how we get to this joint tailored audit plan and program, which becomes part of the joint audit planning memorandum. There are instances when we as audit firm are not planning to do some procedures. This is usually in areas which are below materiality or with lower risk, and then we let the other audit firm perform those additional procedures on their own if they think it's important for them to fit their audit methodology. The same is also valid when we want to add a procedure that is not in the joint audit planning memo. Then we feel free to add it to our own audit program and to perform it on our own. Of course, we are willing and ready to share the results with the other joint auditor. So, those areas that I mentioned where we can have differences in approach are usually less risky areas. For example, when going to administrative expenses, employee expenses, other assets, and similar, which are not critical or typical for the financial industry companies that are subject to joint audit in Bulgaria, because you know maybe from the prior sessions that in Bulgaria we have a boutique implementation of joint audit. It is obligatory only for banks, insurance companies, and pension funds. Of course, it can be performed voluntarily in other instances, but usually it's the banks and the insurance companies that are in the focus of joint audit. So in the areas with significant risk and those material line items, both audit firms perform the necessary audit procedures, which are communicated between the teams in advance. And both firms perform the greater extent of audit samples, so that each firm on its own is compliant with its own audit methodology. So if we compare samples, we usually take the larger one when we perform the audit procedures at a later stage. How the communication happens? In order to be successful, the communication should be divided into two steps. We sit and exchange between the joint audit teams what is the requested information, what is the sample size, what are the items and inquiries, and for example, the schedule with interviews at the planning stage. And one of the firm prepares these and invites the other firm to add additional items or to comment, and then there is only one request sent to the audited entities team. This is the joint or combined list of requests. Prior to sending any comments and feedback to the client, we always ask the other audit firm to add any additional requests and comments. What is important here is how we split the work. We usually use as a starting point the line items in the balance sheet and P&L, and we divide them between the audit teams. Of course, the areas with significant risk are covered by both audit firms, and we can split so that only one firm can perform audit procedures in less risky areas in order to gain efficiencies and to perform joint audit, not double audit for the audited entities. Another benchmark that we use is the planned audit hours, and we try to be fair to split equally the planned audit hours between the two firms, but in the end there are always actual hours that are usually more than the planned audit hours. They are due to unexpected circumstances such as delays in the customer's information, COVID-19 availability of staff, and other factors. We start fairly splitting the work, but in the end, each firm wants to gain the quality of its audit files and audit work papers that are in compliance both with professional standards, but also with their own firm's methodologies, policies, and practices. What is double effort here, but it is part of the regulatory requirements in Bulgaria, is that each audit firm has its own experts available for the engagements for banks and insurance companies. These are usually IT specialists, CFA specialists, valuation experts, actuarial experts. What is good to know is that both teams have such experts and can contribute to the audit work. And in this way, we can get faster solutions and reaching conclusions on some hot topics or some hard to audit areas, especially in the recent year. It was ISA 540 auditing accounting estimates audit standard, which required involvement of a lot of experts and practitioners. So,
Mrs. Dinova,
yeah.
you mentioned something which is quite interesting, and I think that we have something that Mr. Sevos could share with us on exactly this topic. Eric, do you want to take the floor, please?
Okay. Yes, I think the way it works inside the college, it's quite similar to that Sylvia said. Maybe I can add that in the field, after having defined the audit approach and defined the allocation of work and a work program, each auditor works separately on their own tasks. So if the firm A is in charge of the, for example, audit bidding process, the firm A will perform the diligence alone without the firm B at this stage. The cross review is at the end. So it's the same for all tasks, but for key audit matters or significant audit issues, it could be a little bit different. There is still one firm in charge of the task, but both firms will discuss the issue together. So if I take the example of the impairment test, so impairment test is performed on goodwill, and if it's a key audit matter with a potential huge impact, both firms will work on it. Sometimes in a different way, not with the same level of involvement, not with the same experts, but enough to have a secure opinion, which at the end will be a common opinion. And as an example, experts from each firm could sometimes work on the same subject. And it's not double work. You work on the same subject, but with different approach and different methodology. For example, for the actualization rate, they will work on the same subject, but with their own approach, their own methodology. One firm will use a Damodaran database for the calculation of the rate, and the other firm will use alternative methods as fairness finance, for example. And when, with the two different but complementary approaches, you reach a common conclusion, this is much more acceptable and understandable for the company. And it is also much more comfortable for the auditor.
Thank you, Eric. Mrs. Dinova or Mr. Apostolov, any other comments on this aspect?
Yeah, what Eric said is valid for teams, audit teams that involve both international network and local expertise, so that a more balanced conclusion is reached, for example, on market data and comparison with market information. But usually in the risk areas, right now we are not able to achieve efficiencies. I think both audit firms perform procedures on the risky areas.
Thank you. I would like to move on to a second part in this discussion and turn to Mr. Auger and ask him what are his expectation and what is his experience with joint audit as a client?
I must confess that I have no other experience but joint audit because I don't remember of my young years at Aerospatiale. As a consolidated company, a small private but consolidated company, we have got joint audit for more than 20 years, I guess. We always discuss this point because of the fear that cost could be more important. But at the end of the day, we always said that it was a very good point to have joint audit. Four main reasons to achieve to say that. The first one is to say that we have succeeded in mixing two different types of culture. family, well-known but small French audit company, with a great experience, but a great French culture, and with a Big Four. And it is always interesting to mix cultures and experiences. Second point is to say that every audit company has its best, and it's quite sure that with a joint audit, each company brings its best to the client, to the audited company. Third point is that there is kind of aimable but acute competition between the two auditing companies. And when there is a joint audit, it's quite sure that they are very conscious that they can't make mistakes, that they can't oversee points, and that when they have an opinion, they must sustain this opinion with a strong, well-documented groundwork. And it's quite very interesting. I think that joint audit allows that. We have also experienced a fourth point, which is not a good remembrance for us in Bayard, but we have got in the past some difficulties with one brilliant president, but sometimes too brilliant and sometimes trying to make some creative accounting. And I was a finance manager at that time, and it was very difficult for me to resist. And it was we had not yet audit committee. It was very difficult for me to resist, and thanks to the help of our two audit companies, we could make something sustainable, acceptable, I would say. The key discussion was always the impairment test. The key difficulty is always impairment test when you have a company which is growing and making some strong acquisitions regarding its own capacity. And because of that, without this joint audit team, I guess we would have made mistakes. So I have a suggestion, which is difficult to implement because of the 6 years rule. Patrick, my friend Patrick Evans, reminded me that it's quite of a dogma, this 6 years rule. But I guess I suggest that company could have not the same date for the end of the mandate of each company. You could make a 3 years rotation. It would be more mindful for the auditing companies to resist a too creative president or management. If both of auditing companies are in the end of their own mandate, their capacity to resist is weaker. So I strongly suggest that there is always someone in the room which has at least 2 or 3 years of mandate left in order to resist and to say where are the rules, where are the limits not to be stepped over. So
the engagement duration of 6 years is useful in your view, but it should be used in a way that makes
3, 6, 9, 12, I would say. A rotation of 3 years of one of the two joint auditors.
Thank you. Thank you for sharing your experience. We are in.
Maybe I could just say a small point. It's very useful that the area, the different scope of the audit performed by each company must be swapped regularly. It's very, very important. But on the other hand, you must avoid a kind of too zealous competition between the staff in order for them to do better than the prior who did that. And sometimes you got to accept something, and the second one comes and say, no, that is impossible to do that, and please change immediately, and so on and so on. So you have to be aware of that, and sometimes the managers of the team must keep the hand on its staff in order for them to avoid a too zealous approach.
We are in a context where, for at least listed companies, but also on a voluntary basis for others, the standards that are used for corporate reporting are IFRSs, and we all know that these offer principles, are principles-based, but not rules. And therefore, there's sometimes a lot of judgment in the way the principles must be put in place, applied. I would like to ask your views, and maybe also the views of the other participants to this session, about this environment and joint auditing. Does it make things more difficult, or on the contrary, is it useful in finding the right way to apply and the standards?
Good morning, everybody.
May I add a comment, because we work both with big four companies and small companies, and it usually helps to have your own consultation process and to rely on resources, having audit methodology team both locally and as part of our network, it helps very much. But when it comes to hot topics or new IFRS implementation, it's always good to have second opinion, second critical discussion on how to apply new standards, because you know, the practice is limited, and the deadlines for public interest entities are very short, and usually it's a matter of being both flexible, both fast and precise in checking and verifying if the company implements new standards correctly.
Thank you, Silvia. Edmond?
Yes, good morning. I wanted to say that I'm fully convinced of the benefits of joint audits in a deeply moving environment. 16 years ago, I used to be the chief financial officer of a large mutual insurance company, Groupama, when happened the adoption of IFRS. As you mentioned, it was principle-based. It is principle-based. We had to implement the implementation of IFRS, of the unbundling in both IFRS 6 on insurance contracts and on IFRS 9 on financial instruments was just a nightmare. And in the recent period, IFRS 10, IFRS 16, IFRS 15, this has just been awful. And so if you can build on the advantages of the joint audit, since the European reform of audit, the roles of the management, the auditors, and the audit committees has been perfectly clarified. The management prepares the accounts, the auditors review the accounts, and the audit committee controls the review work of the auditors. And first, preliminary remark. Second, preliminary remark. In that context, what is the expectation from audit committees on auditors, joint auditors or single auditors? To provide a joint opinion after challenging each other and to cooperating to assess jointly the choices made by the management. And this has, you will see the benefit of a joint testimonies. This has, in my view, 5 big advantages. The first one, sorry, it's very obvious, but 2 sets of eyes can see more than one single. The second is that I'm sure, it's easier for 2 firms to resist managerial pressure and remain independent than for one single. Third advantage is it increases in a deeply moving environment technical competencies of audit firms, since on specific cases, business cases, they can share experience. 5, it increases continuity of the audits. This is very important. Since the reform, as I mentioned, the audit committee is in charge of controlling the work made by the auditors for preparing on the choices of the management, on the preparation of the accounts by the management. An audit committee is not active continuously. We have between 4 to 8 sessions, meetings a year, lasting 3 years. We can have preparatory calls, conference calls, audio conference, whatever. But as a matter of fact, we are not every day controlling what the auditors do, or the work the auditors perform. Having this cross-checking by the joint auditors on every day's works from the other, I would say, brings enormous value to the audit committee, which during the meetings has just to assess whether this was properly performed, organized, and executed. And last but not least, it was mentioned by Alain, it increases resilience of the audit. Since the rotation is now mandatory, since the European audit reform, if you have a single auditor, when its term of office arrives, you lose the full memory of the previous years, 6 years, 12 years, even 24 years in France, since we have joint audits, and losing that memory is just enormous. If you organize properly and shift the end of the terms of offices of your joint audits, if a mandate lasts 6 years, having 3 years, as you mentioned it, of remaining time of function left, I think this allows you to organize the rotation, having the memory kept for 3 years before the newcomer, the new audit firms, takes its functions and becomes an expert of the company. And when you have, I used to be the chairman of the audit committee of Bouygues for 12 years. And when you have a company consolidating 1,800 subsidiaries, acting in 45 countries, the memories, the files, and not only having the files, but knowing them by heart, I would say, is really, really key for the quality of the audit. And so clearly, I'm convinced that, I hope that we will see in the coming years a sort of a stability of the standards. But in the not fast, but deeply moving environment we have experienced for 15 years, I think that joint audit has enormous benefits.
Thank you, Helmut. Mr. Kostov, would you like to share your views as chairman of an audit committee in Bulgaria?
Thank you very much. Enforcement of joint audit required the audit committee to participate in an additional procedure for approving joint auditor who is involved in the commitment of mandatory financial audit. In our opinion, that provides additional guarantees for improving the quality of the audit work and accordingly in the formation of essential audit conclusions, the reporting of the key audit matters and the audit opinion expressed in the report. According to Bulgarian legislation, joint auditor have to communicate with the audit committee as follows. First of all, the scope of the statutory audit, In turn, the audit committee at the start of each annual audit cycle ensures that the scope of external audit is appropriate. Accepted level of materiality. Communication with the audit committee at the materiality level is important as it determines the value threshold above which identified mistakes will be reported to its member. It is good established practice in course of this communication between joint auditors and audit committee to receive the information about misstatements below determined materiality, but when statutory auditors consider them as material by their nature. The identified risk related to significant estimates, changes in the business environment and regulatory framework, as well as to the business strategy applied by the public interest entity itself. Identifying the alleged risk associated with fraud by management that could manipulate controls that otherwise appear to be working effectively. An important step of methodological support for both the registered auditor and the audit committees in Bulgaria was the development and adoption by the supervisory audit body in Bulgaria and the professional organization of the joint document called Guidelines for Implementation of Joint Audit. This is very similar to the French framework about joint audits. In my view, the positive results achieved and weaknesses that have arisen after applying the practice of the joint audit from the point of view of the obligation and responsibilities of the audit committee can be summarized as follows. As a result of applying the joint audit, an audit committee received qualitative additional reports. They are the result of the greater expertise of the two auditors involved in the implementation of statutory joint audit, which is reflected in the auditor's recommendations regarding the financial reporting system, internal audit, internal control system, risk management system, etc. Extremely important for the audit committee is evaluation of effectiveness of the risk management system and the internal control system and their adequacy to the volume and nature of the activity of the specific enterprise of public interest given by the external auditors. These assessments directly corresponds to the audit committee's obligation to monitor the internal audit activity and the effectiveness of internal control and risk management systems unless expressly addressed by a separate board risk committee, and to propose the action have been or are being taken to remedy any significant failings or weaknesses of those systems. The audit committee is given opportunity to receive more expert opinions due to the increased capacity involved in performing the external audit. The timely communication of the observation and findings of statutory auditors during the external audit, as well as the provision by them of any relevant additional information to the audit committee of the public interest entity, is an important condition for better implementation by the audit committee of its functions settled by National Law and Regulation 537/2014. More efforts are required in relation to communication between statutory auditors and the audit committee, mostly thanks to good coordination between joint auditors we as the audit committee generally have no difficulties to communicate and report on their part, as it is done by them together and simultaneously. Exceptions of this practice are the procedure for approval by the audit committee of provision of services other than their statutory audit for the public interest entity under the Independent Financial Audit Act and Regulation 537. Joint audit system increased the work of the audit committee to observe the rotation of the joint auditor, and also it is connected with monitoring of the independence of joint auditor, which is directly connected to the approvals of non-audit services for both auditors and the need to monitor the non-exceeding of the restrictive thresholds for the ratio of audit remuneration to remuneration for non-audit services. Thank you.
Thank you very much, Mr. Kostov. I would like to ask two quick questions to the representative of the audit committees and to Mr. Auger. Joint audit is often considered as a way to improve audit market concentration. Is this a matter of concern to your company?
For us, for me personally, and I would guess for Bayard also, it's quite important that we keep strong biodiversity in all fields of human life and of human activities. And it's quite sure that joint audit, which allows a company such as mine to appoint a Big Four and also to appoint a medium-sized French company, is quite interesting.
Thank you.
The same. I don't have detailed studies or statistics on the development of the competition. I used to be interviewed 2 years ago in 2019 by the Competition and Markets Authority in the United Kingdom, and that was their concern. They considered that the Big Four has a too big market share in the UK, and they were considering two options. The first one, capping the amount of business one audit firm or capping the market share one audit firm could have, or introduce joint audits. And that was their concerns. And so I don't have very detailed statistics on that, but in my opinion, in the French market, where joint audit has been developed for more than 60 years, what I see, Mazars, first, it has helped smaller companies to develop, and by accompanying their clients overseas, I would say, all around the world, I think it was an incentive for them, a pressure to develop and to grow faster than if they had not had the benefits of a joint audit. So for me, in my opinion, I cannot give evidence of that, I cannot demonstrate it, but my feeling is that smaller sized audit firms develop much better in the countries where there is joint audit than in the countries where there is no joint audit.
Thank you. Mr. Kostov, would you like to?
In Bulgaria, the audit companies which participate in the joint audit procedure are Big Four and medium audit companies. Our regulators in the banking system and the insurance system approved the list of the company which can do this joint audit. You have to prove your capacity to be included. That's I can say.
Thank you very much.
The market.
A second question to you. There are academic studies and other papers that point out that joint audit implies a significant increase in audit costs. What are your experiences in this field?
It's quite sure that when it comes to money, the joint audit companies are jointed. That's quite sure. And it's not an argument for each of them that another company is on the job also. But we have to remind them of the fact that it's a joint audit, not a double audit. And we have achieved a kind of very open discussion post by post, assuming that there are three types of work itself, review of the work, and joint consolidation, and that we have to dispatch the cost of each company, spreading that into these three areas, and come to a point. It's quite sure that it has a cost, but for my shareholders we have been created and still owned by a Catholic congregation, it's quite very important to be sure that the accounts are good ones. They have not themselves the capacity to be sure that the accounts are fair, and it's not a cost for them. It's somehow a kind of investment. So we discuss the point, we discuss the cost, but it's some things to be made, something to be done. It's too important. It gives confidence to the shareholders. It gives confidence to the management, but it gives also confidence to the people employed by the company and to the partners. We have made some great joint ventures with other British or Belgian companies at Bayard, and it was quite important for me to show that my account have been reviewed by two audit companies, one of them being a big four. It's not a question, so it's a cost. It has to be discussed, worked out clearly on an open and frank discussion, but at the end of the day, it's an investment.
Thank you very much. Alain?
Exactly the same. Huh? That was one of the questions of the CMA, since you know the British people, they are very much focused on cost competitiveness, cost efficiency. And first, I don't have the impression that audit costs in France are much higher than elsewhere in Europe or in the world. And even if it's the case, first, it was mentioned by Silvia Di Nova, joint audit doesn't mean double audit. Generally, in the large companies where there is joint audit, one auditor review, and it has been said also by another participant, one auditor reviews the works in one geography or in one line of business, the other one on the others, and then what is in common is the coordination and the cross-checking. So if there is a cost, this is the cost of the cross-checking, and that's all. So yes, maybe it could be a supplementary cost. What are we talking of? The cost of audit is exactly or close to the cost of insurance. When we challenge the companies, the auditors, I mean, with their costs, we benchmark them on since all these costs are public. You can find them in the universal reference documents. So it's very easy to compare in one domain of activity, to compare with the size of the company, the numbers of entities consolidated, with the turnover, whatever. And what I experienced is that we are talking about 0.16 or 0.17 of the turnover of the company in terms of costs. So when you see the disaster of companies going bankrupt, Parmalat, whatever in the United States before, Polypec, Maxwell, okay? I think that if you move from 0.16 to 0.19, yes, it is a significant increase of costs, but as a matter of fact, it is the cost of resilience, robustness, audit quality. So I don't think this is really an issue.
Be careful. Don't be
don't raise
no temptation to increase by 20% your fees.
Yeah, thank you very much for sharing your views on this. You mentioned audit quality. Maybe one of the issues on which we should collectively work is this notion of audit quality and what type of indicators we could find in this area. Are there questions from the audience to the members of this panel? Jacques?
I've got a question to Eric Devos, because on the issue of double audit, because Eric Devos mentioned that there are some complicated topics, in a joint audit he performs, the two firms work on the same topic, we talked about impairment. So I would like to understand what has been the reaction of a company if a joint auditors come with their two sets of experts working on the same topic.
I faced that for the impairment test. It was.
My question was for
Eric, did you hear the question?
No, sorry, I didn't hear. Could you repeat, please?
Can we have a mic?
I'm Jacques Etovenin. No, I was just reacting to a comment you made in your presentation about double work on very difficult issues like impairment, discounting, and issues like this. And for me, it means, in a certain way, a double audit. And we were more talking about, joint audit and not double audit. So my question is, how did your client react when you tell them that maybe because it's complicated, you need to have two sets of experts to make the check, meaning additional fees?
Thanks for the question. It's very interesting to speak about. Sorry, there is an echo. I think regarding tougher situation such as impairment test, relations with the management could be very intense, and I agree with Mr. Auger when he said that sometimes you can feel a sort of pressure. So it's not a question at this moment. It's not a question of double work. I can talk about classic situation when a company doesn't want to accrue a loss, very often for excellent economic reasons. And the auditors explain that even if there are good economic reasons, the gap, the standards require to recognize an impairment loss. So if it's a very difficult issue, that kind of work could sometimes take more than 4 months. And the auditor and financial management work on multiple versions of the impairment between the hard close and the final audit. So it means that one of the firms in charge of this task will work closely with the financial management for sometimes 4 months. And it's very hard to take a step back when you are working 4 months on the same subject with someone. It is very helpful to have your colleagues, joint auditor, who will help you to think with more insight, with more step back. I have to say that as an auditor, we are searching to bring more value to the company and to help them to reach their goal when it's possible regarding the regulation, for sure. But as auditor, we have to assume that. Why? Because it's a way to create good relation. It's a way to create a relation with trust. And with a relation with trust means a relation with trust means more transparency from the management, and it means that you will obtain more easily the information. So it means a better quality of audit. But it's always very difficult to keep a balance between helping the management and keeping independence. And that it is exactly what the joint audit is bringing. When one auditor is free to bring value, to work 4 months on the subject, the other can keep a step back to reinforce independence.
May I give the opinion of audit committee chairs? We welcome when companies work on very tricky, to get both work on tricky issues, and sometimes we require it, you know. In your private life, when you have to face huge capital expenditures, do you ask only one quotation? You always ask twice, two quotations. And what is the difference? Is the difference that only one will perform the work? In the joint audit, you ask for the two opinions to check if they do converge or not, and sometimes there are some discrepancies, but at the end of the day, both audit firms will sign the accounts, and that's the great difference. So it, as I mentioned, robustness, resilience, I think it's decreases the capacity of failure.
Thank you very much for this lively debate. We're running out of time, and we will now welcome new participants. Mr. Mark Babington, who is Executive Director of Regulatory Standards at the Financial Reporting Council. He leads the division responsible for the FRC technical and public policy work, covering audit, corporate reporting, corporate governance and stewardship, actuarial, and the FRC lab. Mr. Babington has a 20-year career in audit and was director at the UK National Audit Office. So welcome, Mark. We also welcome Mr. Michael Zell, who has taken over the management of the German audit oversight body APAS. APAS is responsible for audit supervision in Germany. And we also welcome Patrick de Cambeau, who is the chair of the Autorité des normes comptables, the French accounting standard setter, but prior to that has been the chair of Mazars France and then of the Mazars network. So welcome to you three, and the debate will be moderated by Eric Baudrier, who is the Director General for H3C.
Thank you, Patrick. And welcome to our three speakers. Perhaps just to launch the debate, I think that it could be very interesting to receive from Mark and Michael the state of play of the situation regarding joint audit in UK and in Germany. And also, I think that it could be very interesting to receive from Mark and Michael their own point of view regarding what have just been said by our firm's representatives regarding some advantages of joint audit. If I can just summarize some of these ideas, I've noted is to share a different type of culture, also to have a better work or a better documentation due to the pressure from the review of the other auditors. Also, joint audit could be seen as a rampart against creative accountancy from management. That's to say that they are stronger because they are true. It's also more expertise from auditors which can give more information to the audit committee. Also, I noticed that it could increase continuity of the audit, and the extra cost could be limited, and it could be seen as a cost of the insurance given. So perhaps to start, Mark, I give you the floor to expose the state of play in the UK. Thank you.
Okay, thank you very much, and it's very good to be able to join you today. In the UK, we do not really have many examples of joint audit, although our law does not preclude it. One of the main challenges from a UK perspective for joint audit is that it doesn't fit very well within our liability laws, and in particular the joint and several liability that would sit on auditors. I understand that you have slightly different provisions in France, which of course support the use of joint audit more widely. One of our real challenges that comes out of the report by the Competition and Markets Authority is a need to build capacity in the UK statutory audit services market. And by that I mean that although we have the largest audit firms which exist in many jurisdictions, there is a very steep cliff edge once you go beyond those largest firms. And therefore, one of the things that government here has been considering is what mechanism could be used to build capacity within that challenger auditor sector to allow those firms to grow so that they can take on a larger share of work. An example for you, we have 20 mid-tier firms who together form the Association of Practicing Accountants, and between them, those 20 audit firms deliver about £100 million worth of audit a year. You may have seen recently in the news that HSBC is looking to tender for its audit, and the audit fee for that one audit is £75 million a year. So being able to digest the largest jobs is always going to be something of a challenge, and that's why we need to build capacity through other ways. Our consideration, primary consideration, will always be how to do so in a way that preserves and protects audit quality. And therefore, as things stand, we believe that having one auditor responsible for signing the auditor's report and focusing on their statutory role helps in the best way to do that. I should just say, as part of the context, in 2016, when the audit regulation and directive came into force, we were responsible for regulating about 75 audit firms that carried out public interest entity audit. That number has now dropped to around 35. And that is either because firms have merged or been taken over, or because they chose deliberately to get out of the public interest entity market. And therefore, the focus at the moment with the government's proposals about shared audit is a way intended to build up the number of firms that are capable of playing and delivering audit services in that market to one where we have greater diversity. And I know from discussing previously with colleagues in France, you have a much greater diversity in terms of the number of auditors than we do. And we need to look at particular steps that will increase the number that play within our market. But that's a very quick overview of the sorts of issues that we're dealing with in the UK. Obviously, once other speakers have given their contributions, I'm happy to deal with any questions.
Okay, thank you, Mark. Michael, what is your point of view?
Yes, thank you very much that you have invited me. I can close my remarks by saying I completely support the analysis and the analysis and the respective confirmations by my British colleague. It's the same in Germany. We have the Big Four that have more or less about 80% of the public interest entities auditing. And then we have the next 10 where they do, well, more or less the auditing of pies that are pies not from the volume of their balance sheets, but because they are from one way or another fall under the definition of a pie. So it's an overall business of the Big Four and a very few others. And if you would draw a timeline, I can completely assure what my British colleague said. The numbers of pie auditors outside of the Big Four are very, very limited, and they are declining. So all in all, I'm pretty sure that there will be a much stronger appearance of the Big Four companies in the future on the pie market. It is highly specialized, and I only see, as long as it is not demanded by law, that joint audits will not be considered feasible. More or less, the Big Four tried to do once in a while a joint audit, usually based on either a specialty in some very limited market share that they have not built up a scale by themselves, or just to make sure that they have done one. But the Big Four Big Four auditing firms are not very much interested in doing joint audits, and therefore without incentives on the one side, or making it in some way or another prerequisite by law, I do not see joint audits as a future in the German market. One has to say that from our government, we had well, not only from the government but from the parliament, we have enacted a law in recent months that says that there is, under special prerequisites, an unlimited liability for damages to third parties resulting from, well, gross negligence, respective premeditation. It is derived from the Wirecard scandal, you know about it. That says there can be an unlimited liability for damages, and that is therefore not really coverable by insurance, and therefore more and more of, well, general interested auditors to stay in the market of pie auditing vanished. So all in all, the future of joint audits is grim under the current legal situation. One has to say it that frankly.
Thank you.
Thank you.
And thank you, to be frank. I have noticed that for the UK and Germany, the main concern could be the market concentration. So it's a good transition to give the floor to Patrick de Cambourg, because the question wise is how to have other big competitor than the big four. And in France, we have had a good example regarding that with Mazars. So Patrick, I give you the floor to perhaps to explain how the joint audit have had an effect on the growth of Mazars.
Thank you very much, and good afternoon to all. Yes, I'm very happy to testify in this webinar. During my long tenure with Mazars, I developed strong views about the benefits of joint audit in terms of technical quality, of corporate governance, and also of diversified audit services offering. This is a long story indeed, since we must all remember that at the beginning of the 90s, joint audit was considered by most as an odd system specific to a strange country, France, system that was to disappear shortly. If I may tell a little anecdote, a big firm colleague of mine told me then, so in the 90s, you have blue eyes. This is a recessive genetic feature. Joint audit is bound to disappear as blue eyes will, and quicker. Most fortunately, he is now proven wrong. Needless to say what my reaction and response was. Now, joint audit is a recognized and highly regarded system in France, of course, where the proof of concept has taken place, and also in the EU, where joint audit has gained full legal recognition, even if in the transposition of the audit regulation, the audit directive, it has not been mandated in many countries. I left Mazars more than 6 years ago to take a public position as chair of the French Accounting Standard Setter and as a member of the board of AMF and ACPR, supervising the financial markets and banks and insurance. Today, I do not necessarily express the views of these institutions, but I can share with you that my public experience of the last 6 years has only reinforced my strong views, the strong view that I mentioned earlier. Briefly, my experience from the field as a partner in charge of large PIE audits confirms the benefits in terms of technical quality. Confronted with complex issues or difficult situations, the two pairs of eyes concept and the resulting professional dialogue have always been exceptionally efficient. This experience confirms also the benefits in terms of governance. Diversity of cultures, approaches, legal backgrounds stimulates productive dialogue with management, audit committees, board, shareholders. This has already been explained by previous panelists. I would like to add that the operational aspects of joint audit, such as allocation of basic tasks to avoid duplication, rotation of audit fees, progressive shares in the audit, joint conclusions are manageable, and that the additional time and cost needed are minimal as compared to other systems, and above all, to benefits. I would like to mention also that insurance cover is, in my view, not a real problem, because in case of a major problem, anyway, insurance covers provided even by large firms, in my view, would be insufficient. So, anyway, all firms are confronted with an insurance cover issue. I would like now to focus on the benefits in terms of diversifications of audit services offering. I share the concern that the market is over-concentrated with a lack of options and the risks related to the too big to fail situation. The Barnier attempt in 2011 to diversify the market, including via joint audit, met fierce opposition and did not succeed. I and many share the view that in the public interest, a best 10 offer of services would be far superior. What is the relation between joint audit and diversification? I'm happy to testify. Retrospectively first, Mazars was small, had strong views on technical qualities and governance, had also robust values such as no goodwill in partner transactions, and the willingness to translate these into an original culture of service based upon a combination of rigor and dialogue. Mazars needed the opportunity. Joint audit provided and provides this opportunity, which led the small partnership to grow to an international partnership of over 30,000 professionals today. Joint audit combined with our strategic direction of travel created a virtuous circle. Mazars has built capacity over time and contributed to an increasing number of CAC 40 audits, from a couple to between 12 and 15, depending on the composition of the index. Mazars' share in the audit also moved up from a minimum of 20-25% to be able to form a view to between 40 and 60%. Mazars also diversified its sector expertise, including banking and insurance. I frankly sincerely believe, that other firms can follow a similar path with a proper regulatory incentive. I would like to add a word about a perspective regarding the market in the EU. I happen to be at the moment heavily involved in the sustainability reporting development in the EU, in particular in terms of standard setting. With EFRAG, since I chair the task force on the elaboration of EU sustainability reporting standards. I have, of course, analyzed the situation of the CS, deriving from the CSRD, and we all know that CSRD is creating a new environment for sustainability reporting in the EU, where not only 50,000 entities are going to be required to provide a sustainability report, which at EFRAG we tend to call the sustainability statements, as a second leg to corporate reporting on an equal footing with financial statements. But it will also address environment, social, and governance topics and subtopics. So it is a comprehensive reporting that is going to happen in the years to come, with possibly a step-by-step approach, a progressive enhancement towards a fair view or a faithful representation, possibly towards the end of the decade. What is more important is that the assurance of the reporting is a key feature introduced by the CSRD. And as you may know, the Parliament has already mentioned that they would like to speed up a little bit the idea of moving to reasonable assurance from limited assurance. So in that context, I think that auditors will have a crucial role to play. And the crucial role that they have to play cannot be, in my view, an environment where the concentration would progress even more. I think it would be, a contradiction as compared to the objective of what I call the best 10 offer of services. I think this is a golden opportunity for a global understanding and a global commitment of the players to share sustainability reporting. Audits are going to represent a significant progression in terms of activities for auditors and maybe some other third parties, but I think the likelihood of having auditors taking a fair share of that role is high, because there is a significant interest in connecting the two, since connectivity is, of course, on the agenda, connectivity between financial and sustainability reporting. Therefore, I think this is an opportunity to strike a deal at EU level in order to diversify the offer of services and allow for, new players to play a role both in financial reporting audits and in sustainability reporting audits. Anyway, on the sustainability side, everybody has to invest, including, the larger firms. So having to invest, I think is a way forward, and it is in the public interest. If I take my current position, it is in the public interest to have a broader spectrum of players in this market, as demonstrated by some players, including Mazars. Thank you for your attention.
Thank you for what you are saying. Mark, do you have a reaction?
Well, only that I do recognise many of the challenges that Patrick's just set out, particularly with the ever-growing expansion of greater demand for assurance services over more information and different types of information. And I still think that we have to overcome this difficulty about audit firms engaging in the public interest entity market, or it will mean that we continue to see greater consolidation of these services around a small number of very large-scale providers, which I agree is not necessarily in the public interest. One of the things that concerns me equally is that participants today will be aware that the government in the UK has been considering whether or not there should be an internal controls type regime, a sort of Sarbanes-Oxley type regime. And if you begin to add Sarbanes-Oxley, assurance of ESG and climate information, the audit itself, support in financial transactions, you begin to come up with a package of services that is a very significant multiplier of the audit fee itself. And I think that is why we've seen a number of stakeholders in the UK calling for stronger controls in the shape of perhaps mandatory caps on the share of a market that a particular provider can have. And I know that is something that government is considering carefully.
Thank you. Michael, any reaction?
Yes, what I hear about the Mazars approach is what we here noticed ourselves. It's an idea of a firm that says we are taking respective approaches, maybe to become the fifth. Not only the fifth, but becoming one of the big five. But this is based on the management idea to grow beyond their borders. And this is not what I see from the medium-sized auditing firms in Germany. They want to grow in the German market, but I do not see that they are interested in becoming European and on the next level maybe international champions, or maybe not champions, but serious contenders. And so unless there isn't a will to do just that, or to make joint audits necessary by law, I do not see that we open up the oligopoly of the Big Four. And on the other side, the Big Four corporations have always said, if there is an interesting new field that is feasible to conquer for us, they will do. And if we do not have other firms who are more specialized and can do it for a competitive price, I do not see the next fifth or the next sixth. This is well, not a passive. Well, this is not a pessimistic voice, but it's derived from the facts we see in the market. So, first of all, we have to have the will of the medium-sized auditing firms to become a serious contender to the Big Four. And on the second, they must have well, an environment that lets them respectively grow. One of the issues is that according to European law, you can exclude certain Big Four auditing firms from making an offer if they are bigger than a certain threshold. And it's in our new government's manifesto. There's a sign that says, we want to see whether German government-owned corporations might exclude 3 of the Big Four from making offer for auditing and allow medium-sized corporations to enter into the auditing world of the government-owned corporations. But whether it will work out, we do not see yet. The coalition contract, which is the new government's manifesto, has only a very small part in it regarding this issue, and we will see whether it will be introduced in one way or another. Thank you.
You're welcome. Thank you very much. Perhaps to come back on what Mark has said in the beginning. Mark, you have talked about shared audit that could be implemented in the UK, and it could be a solution to raise the problem of market concentration. So perhaps a question regarding that. To your point of view, why could be shared audit could be better, could be a better solution than joint audit to fix the problem of market concentration?
So one of the concerns is in part driven by the small number of participants in the top end of the statutory audit services market. So if I focus particularly on, say, the FTSE 350, and the concern there is that when a company tenders for an auditor, it has extremely limited options because it will have an incumbent auditor. Quite often it will use another big firm to provide tax services. And quite often a third may have been used to deliver particular programs. And so therefore they have extremely limited choice. If we were in a situation with joint audit, that would take a further participant out of the market when it came to re-tendering again. And one of the things that we have been looking at ways to sort of address is to say, how do we get to a stage where we have more participants in the market who can demonstrate their credibility to pick up additional audit work? One of the ways to do so is to give them certainty over the ability to be able to the ability to be able to win work and keep work, to allow them to invest in business capacity. And I have to say that one of the things that we were particularly interested in was the French example, where you have tenure, I believe, for auditors when they're appointed. So they almost have a very strong support to stay in post for a number of years after their initial appointment. So we looked at ways to support that growth, and we looked at ways that would also support audit quality by linking that growth to an engagement that would lead to a separate signed auditor's report. One of the things that I think I'm very aware of is that these measures are not going to solve a problem overnight. One of the things that we want to be able to do is expand the capacity in the marketplace, but it is going to take time to build that. And when you look at the Competition and Markets Authority's recommendations, which were principally in respect of the FTSE 350, even at the low end of the FTSE 350, there are still significant audit fees, which means that you have to mobilise a significant amount of resource to do the work. But what the CMA was particularly concerned about is it didn't want a two-tier market where challenger firms were seen to be operating in either the smallest, the lowest fee, or perhaps the most reputationally difficult audits. It actually wanted there to be genuine participation throughout. Like, I have to say, it's not an easy problem to fix, but it is one that we have to turn our attention to, and hence the proposals that government has consulted on. Thank you.
Thank you. And Michael, in Germany, is shared audit could be also something that you have analyzed?
Pardon? Could you repeat it? I didn't hear you quite well.
Yes. My question is to know if in Germany you have analyzed shared audit as something could be implemented.
Well, you can implement it. I mean, it's not precluded, it's not forbidden, but for this form, there is no actual demand. The auditing committees usually do not ask for it for their or ask for it to their leading auditor. So there is no demand by the board of directors or the oversight committees. The auditing firms do not seem to be very interested in, from their business point of view, except the few exceptions I mentioned, very specialized, or if they have to cover a marketplace, they have no experience in it. And the third is that the medium-sized German auditing firms are not so much interested in being a contender. So that makes it quite difficult. I mean, if you want to start in the Olympics or in World Cup finals, you have to have, first of all, you have to have the will to start there and be a serious contender, and we do not see that. And those who are governing the market are not very interested to have new contenders they challenge on their home turf. So I do not see any serious link to foster joint audits, unless you find it necessary to put it into a law and make it a legal obligation. But this hasn't happened yet, and as far as I see the manifesto of the new government, there is no chapter that says joint audits may be the solution of it. So that makes me a bit open in my, or frank in my observations. But I see the problem, no questions. But what I do not see is that from a political point of view, from an economic point of view, and from the business intended view of those who could become potential contenders, are interested in just making that. And from a final viewpoint is, if you have a multinational audit, you have to make sure that you have the respective control system and quality control system. And the quality control system, in one way or the other, we have seen the exception in Wirecard, but is apostrophe a universal quality control system, especially if it comes to auditing. And this investment and this execution of these quality control systems leads to the notion that the minor, smaller firms have to adopt that to become, joint auditors. At the end of the day, as my British colleague said, the auditor in charge has to sign it. And the last one who has to sign it has to make sure that the minor joint audits are that good that he writes and signs it for himself and for his firm. And they are not ready to do that. So all in all, without further legal necessities, I do not see that that this concept will thrive.
Okay, thank you. Our time is
and I see my last word, and I see that the colleagues from France have a different approach from the Mazars business concept and from the respective government that demands it. So that's it. Thank you.
You're welcome. Thank you for all you are saying. Perhaps just giving the floor to the audience for question. If someone have a last thing to say. Nothing more. So I turn myself to the audience to see if you have any question. Oh, we have a question here and on the first.
Merci. Thank you. Good morning. I'm Jean-Charles Boucher from RSM. I'm partner at RSM. I have just one question regarding Germany. During the discussions raised while finalizing the audit reform in Europe, Germany was ready to implement joint audit for banks and insurance companies, considering that those entities were risky. What are your views on that approach, and could you please give us the reasons why the government finally did not implement joint audit on these entities?
Well, in my opinion, they didn't consider it feasible for the German market. That's it. So we had the legal opportunity, and the government said it's not necessary to advance the apostrophe fight against the concentration on auditing services. So it was not considered as a measure to fulfill the aim. That's it.
We have another question just here. Take the mic.
Michel de Fabiani from ECODA, the European Confederation of Directors. I think whether you have single, shared or joint audits, the question remains, we have an oligopoly. It's not a monopoly, it's an oligopoly, and oligopolies in Europe have to follow rules, are subject to checks, and the institutions who are in charge have to do their job.
Yes, I have nothing to add. But it's not a question, it's an affirmation. So, no more question. So thank you all for your attention. So thank you to our speakers for their participation. Now we will have a break, a short break of 1 hour for a lunch. So see you at 2 p.m. Thank you very much.
Okay. So welcome again to this room for the second part and fourth session of the joint Audit Day event. This session will be dealing with a topic that has been mentioned earlier this morning, which is an important one for audit firms and legal liability. And we will have 3 presentations or talks from the regulators that are involved in this event, meaning a representative from CIPOSA in Bulgaria, Mrs. Dariana Kotseva, will make a presentation about the legal framework for liability of the joint auditors. Mr. Jan Tega, who you have seen this morning from IRBA, will also describe the way this important notion of legal liability for the joint auditors is dealt with in South Africa. And Thierry Ramonaxo, who is head of the H3C Enforcement and Investigation Division, to my left, will describe the current situation in France. If I may, would like to give the floor to Diana. Okay, we can see you. I think there is a presentation.
To share my presentation now. It's Okay, is it visible, my presentation?
No, not yet.
Okay, try. Okay. Now is it visible?
Yes, it is. Thank you.
Okay. Good afternoon. I will start my presentation with the legal framework of joint audits in Bulgaria. The legal framework of joint audits in Bulgaria is covered by several legislative acts. The first legislative act is the Independent Financial Audit Act, and it is stipulated in that law that the registered auditor shall be held financially liable for the damages caused by the registered auditor by him if these damages are the direct consequence of his wrongful act or omission. The Independent Financial Audit Act explicitly states where the financial audit has been jointly performed by more than one registered auditor. Registered auditor's financial liability shall be joint and several. Also, it says that registered auditor's liability to the planned entity shall be limited to the triple amount of the insurance fee for the registered auditor professional indemnity insurance, but not falling, however, below the amount specified in that law concerning this professional indemnity insurance, concerning the amount for one single insurance event. Limitation of liability shall not apply in the case of intentional misconduct by the registered auditor, including where the client entity is being declared bankrupt. It also said that when there is a disagreement, each registered auditor shall submit his or her opinion in a separate paragraph of the audit report and shall state the reason for that disagreement. The other law which explicitly covers the Joint Audit Act is the Credit Institution Law, and it actually states that the banks there is an obligatory requirement for banks to have their annual financial statements audited by jointly by two audit companies. It says that the annual financial statement of each bank of individual and consolidated basis are subject to independent financial audit jointly by two audit firms that are registered auditors under the Independent Financial Audit Act. Actually, each bank in Bulgaria shall agree in advance with the Bulgarian National Bank the selection of auditors. The Bulgarian National Bank has to approve this to the joint auditors. And the Bulgarian National Bank, in agreement with the Commission for Public Oversight of Registered Auditors, adopts criteria for coordination of that selection. Also, the insurance code in Bulgaria declares that the annual financial statements of an insurer, respectively a reinsurer, an insurance holding company, and a financial holding company with mixed activity with registered office in the Republic of Bulgaria, also are subject to joint audit reports. Also, the same requirement stays for the pension insurance companies. In the social insurance code is stipulated that the annual financial statements of the pension insurance company and of the pension funds managed by it are certified jointly by two audit companies. In Bulgaria, there are guidelines which have been developed and adopted by the Commission for Public Oversight of Statutory Auditors in coordination together with the Institute of Certified Public Accountants. And these guidelines are one main document which define the role and the responsibility for joint auditors. First, they define that the auditor's roles and liability is joint and several, they're equally liable. No matter what the division in their work, they are held equally liable. There are no limitations for liability due to negligence or poor quality of the other joint auditors' work. Also, the guidelines envisage full cooperation and joint endeavor by both joint auditors. They are obliged to express a single audit opinion. Also, the guidelines cover the topic when there are cases of disagreements, when there is a contentious matter and it cannot be resolved by the joint auditors. The responsible auditor shall document this in the audit file, the disagreement on the matters, which was significant to the audit areas of judgment, as well also the grounds. And the document should contain the following information. It should contain the description of the contentious matter, the applicable auditing standards, the proposed resolution of the issue, and information of the actions undertaken to resolve the issue. Each auditor is obliged to make necessary efforts to resolve this difference with the other joint auditor prior to the issuance of the auditor's report. In these rare cases, when they cannot solve the problem, when there is no agreement, then they have to modify their auditor's opinion, and there should be a paragraph. Included in the opinion included in the audit report. They should state the reason for their disagreement. As I said, there are joint criteria and procedure for coordination of the selection of bank and insurance companies auditors. And speaking about the criteria for auditors of banks, the Bulgarian National Bank, in coordination with the Commission for Public Oversight of Statutory Auditors, has adopted such criteria and procedure for coordination of the selection of bank auditors. And there are two main criteria. First, there are strong professional qualification criteria. And second, there is a criteria which is related to lack of conflict of interest and good reputation. It's forbidden that the auditor if he has some material interest in a bank, or if he's in the governing body or is an administrator, it's not allowed for him to be a part of the joint audit. The same criteria apply for auditors of insurance companies. Also, again, they're related with their professional qualification and lack of conflict of interest and good reputation. Talking about the liability, we can talk from two different points of view. First is the civil liability for joint auditors, which is covered generally by their professional indemnity insurance, and secondly, it's their administrative pecuniary liability. Generally, the legal liability of the auditor covers all obligations for compensation of damages, both those that are caused to the audited entity due to non-performance of contractual obligations, and also those that are direct and immediate consequence of breach of general legal obligation of the registered auditor. If the auditor doesn't perform strictly the audit engagement, it doesn't perform it well in accordance with the auditing standards, and this results in direct and immediate damage to the audited entity with which the auditor is a contractual relationship. It's clearly a contractual liability, and it's governed by the Bulgarian law on obligation and contracts, speaking about the consequences of non-compliance. Also, third party may also claim damages on tortious grounds, for example, failure to maintain professional secrecy. The auditor's liability is limited and personal, but only if it's contractual and unintentional. Only if it's based on negligence. Then it's limited to 3 times the amount of the agreed remuneration, which may not be less than the amount specified in the law for one insurance event. Full liability, it could be also full liability, and full liability arises when his or her intentional actions have contributed to the insolvency of the entity. The responsibility of the auditor is based on guilt. It is the responsibility of guilty action or inaction. Solidarity is present in both contractual and tort liability. The liability is governed by the rules of law on obligation and contracts, as I said, and it's carried out according to the general claims procedure. Liability could be waived if the violations are directly related to the actions of the management, as well as for the detection of fraud. The burden of proof falls on the audited entity, which claims compensation for damages caused by the auditor's wrongful and culpable acts and omissions. It must prove that the auditor has violated its obligations under the law and the contract, that damages have occurred, specify their amount, and prove the causal link between the auditor's conduct and the damages. Guilt is assumed, and if the audited entity claims full liability, it should demonstrate that the auditor's actions were intentional. The auditor must prove that he is not at fault, that he has done everything possible and necessary to anticipate and prevent the damage. He must be insured for liability for damages resulting from culpable failure to fulfill obligations. As I said, this professional liability insurance is mandatory. Talking about the administrative pecuniary liability, when the inspection is performing its, when the Commission for Public Oversight of Statutory Auditors is carrying out its inspections and finds out that an auditor has committed an administrative offense, when we're talking about joint audits, it's actually the situation where a notice establishing administrative offense could be issued to both auditors when we have a situation with joint audit. This is the principle. Basically, I covered the subjects. Thank you very much for your attention.
Thank you very much, Tariana. Thierry, the floor is yours.
Thank you, Patrick. Well, I'm really delighted to participate, to attend this meeting. It gives me the opportunity to share with you my recent experience drawn from past enforcement cases or past enforcement, not only enforcement, but investigation cases. I try to share with you my personal insight about the implementations of the NEP. It is French auditing standard, the NEP 100, concerning the joint audit. But just to clarify this last point about investigations, when I am talking about investigation, I mean some different points that we have identified as potential violation of this particular or specific legal provisions. But it doesn't mean that these facts have been always eventually sanctioned. I think it's important to underline this point at this stage of my presentations. Just one point. We know that disciplinary investigation are always considered by audit firms and partners like a very serious matter regarding the consequence about the reputation of the audit firms, and we take into care of this too. And I just mentioned that since the beginning of the investigations department, we have conducted over 200 cases or investigations finalized by a report, and on these 200 cases we dealt with only 30% have been sued and finally sanctioned. Well, due to the time limits, I will start my presentation immediately. So I think it's not useful to come back about the legal standpoint and to remind you the contents of the French article of the French Commercial Code 823.15 because I think its point has been dealt with this morning. I just want to underline 2 points that seems to me very important to highlight. The first one is that the joint audit enables to put in place a common purpose between the auditors, and it gives the opportunity to have an extra set of eyes. I think it's very important to ensure and to maintain a high level of professional skepticism and independence. And the other point I would like to underline is strengthening of the position of the auditor vis-à-vis the audited entity. What is this point? I think that in some circumstances, we have detected that in some circumstances, and for instance, if a financial management of audited entity try to prevail its point of view against a single auditor about a controversial accounting treatment not compliant with accounting rules, two auditors, it's my point of view, I'm sure that you will be able to share this point with me. Two auditors should both withstand it better and deliver a stronger opinion on financial statement. I think that we can apply to these situations and hold adage, united we stand, divided we fall. I think it's a good illustration of this principle. The other point I would like to underline at this step of my presentation is concerning the I3C guidance for one of the major topics. It is one of the major topics. Another point is very important, according to me, is the distribution of tasks between joint auditors, which must be balanced, not equal. It's not equal, it's not 50-50, but just balanced. And in some circumstances, in some cases, we met some situations in which there is no balance between the auditors. We have faced a situation with a number of auditors is very unbalanced, and it's raised a difficulty, a problem, because the consequence is that it's an inability to support the opinion and the violation of auditing standards. This point seems to me very important. The other one is what is the cruise review? What is behind the cruise review, in fact? I just want to remind at these steps the main principle of cruise review, and they are the following ones. Joint auditors are jointly liable for the audit performed, and each auditor conducts a review of the work performed by the other auditors. I think that just a reminder, of course, this review allows an auditor A to assess the audit work carried out by an auditor B and vice versa. And the assessment comprises, and just a reminder, assessment of the conformity to the work plan defined in the national registrations, assessment if sufficient and appropriate audit evidence have been collected, and assessment if relevant and coherent conclusions have been drawn. Now, comment on revient? J'étais trop vite, c'est pas grave. Now, I would like to say a few words about issues identified during investigation concerning implementation of the NEP 100. From past investigation cases, we spotted some particular issues that could be representative of an incorrect reimplementation of joint audit violating auditing standards. The first one is the question of consultation on the work program. In some cases, we detected that this consultation on the work program has not been insufficiently implemented or not implemented by the joint auditors. It's a very relevant and crucial point. I just want to remind that such items, as described on the slide behind me, such items are being identified in some cases, and these cases have been mainly reported by inspection reports at the origin of the referral of the Enforcement Investigation Division. But we are not only sized by the inspection control inspection division, of course, and we have in the other case with the different sources of referral coming from external or different authority. The second point is a joint auditor A perform an insufficient cross-review of the work performed by joint auditor B, and it's the most common case we met during investigation. It's one of the potential most important case. So I think it's this insufficient cross-review can be materialized by a series of criteria or series of facts. I give you just some example. Lack of thorough cross-review by A, lack of professional skepticism by A on the nature and scope of work carried out by B, insufficient documentation at the cross-review. I think that we should not lose sight of the main issue. Joint Auditor A must demonstrate in his audit files that the nature and extent of the work carried out by Joint Auditor B is sufficient and appropriate to obtain a high level of assurance as the absence of material misstatements in the significant accounts audited by the Joint Auditor B. And to conclude, because the time is quite lapsed, concerning the concluding remarks, I will just mention that those investigation cases are probably not representative of the ongoing implementation of joint audit in France, which is highly effectively in the most cases. I just remind the number of cases open and the number of cases final issue by the HRC, and you can see and verify, check this point. We make sure, in fact, I think that the most important maybe could be, it's my point of view, to make sure that joint auditors are able to keep efficiency and professional skepticism. And we have to take care of different points. These different points are, according to me, the following ones. Hold a good working partnerships and a high level of communication. It's very important. It's crucial. It must be ensured, the other point, it must be ensured that joint auditors have the skills to audit certain audit cycles, IT audit, for instance, review of internal control, financial instruments. So I think that a joint audit is respecting both those requirements and also provision of auditing standards, including the NEP 100, is a factor in securing the quality of the opinion issued. Thank you very much.
Thank you, Thierry. Jan, could you please provide us comments regarding the the application of liability to auditors, to joint auditors in South Africa when deficiencies are observed by the regulator?
Yes, thank you, Patrick. Good afternoon to all the attendees and participants of this event. So due to the time limits, I'll also start with my conclusion and then I'll work backwards and see how much we can get through it. So in essence, within the South African jurisdiction, we don't have separate legal requirements for joint auditors. Therefore, the normal legal provisions in our Act will prevail. So our Act is called the Auditing Profession Act. There's a particular section in there that deals with the legal liability of an auditor, auditor in general, which is section 46. But in essence, if we apply it to joint auditors, the conclusion is that each joint auditor is independently liable towards the client and or third parties, right? Practically, because we've got joint auditors, what that means is that the joint auditors are jointly and severally liable, right? Then you move back and you go into the Act itself in terms of what the Act says. So there could be various reasons why the joint auditor could be liable. An auditor can attract criminal liability due to the contravention of the various sections of the Auditing Profession Act, or they can attract civil liability towards the client or third parties. The auditor attracts civil liability towards the client for failing to comply with the statutory duty of care and skill towards the client, so in other words, not doing the job correctly, or for breaching the terms and conditions of the agreement that the auditor has with the client. The auditor can also attract civil liability towards third parties due to having acted, for example, negligently, which my colleague earlier spoke to, in providing a clean audit report when it should have been qualified, or where the third party relied on the auditor's negligent misstatement, and the third party suffered a loss as a result thereof. So that's literally the ambit of how the legal liability applies in the joint audit scenario. With respect to how we regulate it from a regulatory perspective, because these are joint auditors, what our inspections department does is we issue an inspection findings to the joint auditors in duplicate. So the same inspection finding is done twice and sent out to our joint auditors, and we expect them to respond jointly as well in terms of responding to the inspection findings. And how we take it forward as the IRBA, the Independent Regulatory Board for Auditors, is we will then decide how we take it further, whether we take, we sanction the joint auditors together or individually, or the partners for each who perform this particular engagement. So the sanctioning happens on different depending on the matters of the case. But the operational matter is that the inspection findings is sent to all the joint auditors, and all of them are sent the same inspection findings, and we expect them to respond to the inspection findings together as the joint auditors who are responsible for the joint audit engagement. Patrick, if I've got some time, I'll speak a bit more, but I'll hand over back to you now, please. Thank you.
Thank you very much, Jan, and it was very clear. Unfortunately, we're running out of time. Therefore, I will just ask if there are questions in the room. Okay. Well, thank you very much, Jan. Thank you, Diana, for this presentation. Thank you, Thierry, also. And we will close this session of the event and move on to the next panel. And I will invite Marjolaine Doblado to come here and to make her presentation about the audit market.
Wait a few minutes or seconds until my presentation is on. You will see a lot of figures, so if you are allergic to figures and to graphs, it's your moment to turn to your emails. But now, okay, so this session we'll deal with a certain number of information that are coming from the last market monitoring report of the H3C. As you know, every 3 years we do a deep dive into the market, and the figures that we will present today are coming from those figures from market monitoring. So, by allowing a distribution of the audit work between 2 or more audit firms that do not belong to the same network, joint audit can impact the structure of the market. So the presentation will start now with the overview of the general market in France. So by setting the scene, I would like just as a reference point to let you know that in France there are 271,024 engagements, which are here in the total market of the entities which are subject to audit requirement. And with regard to that, we have 4,000 active audit firms in the full market, and also more than 5,000 individuals appointed as auditor for specific entities. If we compare the market shares in 2 buckets, we have the first bucket with the 5 biggest network. As was mentioned this morning, we treat 5 networks in the same bucket because they have quite the similar size on the market. So those account for 27% of the engagement, and so the other firms have 73% of the remaining market. So you have a graph indicating this percentage. If we look at the perspective of the fees, you see on this graph here that the 5 biggest networks have quite a similar size of the market in terms of fees, and that half of the market is divided between the remaining other firms. That's just for the general market. Moving here to the pie market in particular, so that's the market in which we have the most joint audit. As indicated previously, the requirement for joint audit is for the entities which establish consolidated financial statements and publish them. So in this pie audit market, we have, I think, approximately 60% of the engagement which are performed jointly. And so in this market, what's interesting to note is that we have 250 audit firms, a bit more than this figure, that are working on that market. So here in this table, you have the figures, meaning that for listed companies, there are 2,005 active audit firms to audit the listed entities. For the listed banks, we have 16 firms engaged in this market. And we have also for insurance more than 100 actors that play a role on this specific market. So a lot of actors can be involved in the market, and we believe this is partly due to the fact that there are some joint audit engagement in this market in particular. If we turn now to the pie engagement by network, you have here a chart indicating what is the respective size of the network. So you will see that there is quite a balance between the various networks in this number of pie engagement. So you have here 5 networks and the 250 other firms that are in one graph. Okay, if we have now a comparison in terms of audit fees and the revenues that the audit firms have from their engagement, you will see that the predominance of the 5 biggest is higher. We have here the representation of the proportion of each of the 5 biggest network for France, and we see that they have a respective higher size than the smaller firms, the 250 others, which have a limited part of this market in terms of fees. So meaning that the fees are most driven by the big 5 for the French conception. Okay, if we go now to a comparison of those figures with the ones that are available on the EU market, the reference point that we took was the report that is prepared by the European Commission every 3 years, and that is based on the figures that are compiled from and collected by the members of the CIOB and counterparts, audit regulators in Europe. So I will turn to the next slide, so please don't be afraid, because even if the screen is big, you may get some difficulties to read this graph. If I give you some explanation, you have here the respective size on the market of, in the first line you have the big four market share in percentage from the engagement. The second bar is the 4 biggest player in each of the countries, and the last bar is the 10 most important players in each European countries. So of course it's a bit difficult to read, so we have extracted some data so that it's a bit easier to read. Here you can see just the figure of the market share from the big four on the PI statutory audit market. So the first line is for Luxembourg. In Luxembourg, you see that you have 90% of the engagement which are audited by the big four. Then you have Netherlands, Ireland, and the UK, where the market share is more than 80%. Then you have Spain, Italy, Germany. We just selected the biggest economies from the previous table. So those two countries see that there are more than 70% of the engagement of the PIs that are held also by Big Four. And the number for France is around 52% here. So you can see that the difference is quite important between the other economies and France. And then you have 2 other bars. So the situation is even less concentrated in Portugal and in Bulgaria. So the colleagues from Bulgaria have the best the best deconcentrated market, where we have only 12% in the hand of the same 4 bigs. Okay, let's move now. So that was for the comparison between the French market and the EU economies. And we just wanted to finish this presentation by a few takeaways from this market data. First of all, to remind that we have 250 audit firms that are active on the PI audit market in France. 5 main networks, and you saw the figures and how the distribution was done between those 5 main networks in France. The market is certainly less concentrated in France than in most EU countries. And we believe that the access of the PI audit market is really facilitated by joint audit. Now, is this situation fully satisfactory? The H3C, when preparing and issuing its report in 2019, wanted to highlight that there are still some difficulties for the upper level of the market, meaning the very big international groups of entities, which sometimes have the tendency to choose for instance, 2 big four firms. And of course, this has no deconcentration effect on the market. And some of the questions that the H3C raised at that time were to think about any mechanism so that the College of Auditors would comprise a bigger player, but also a challenger firm, which would have a more deconcentrating effect, on the market. The other question that was raised by some constituents were to say, should joint auditor be only for 2 auditors, or should it be for 3 auditors? Would that have some better impact on the concentration? And the other and the last question that I offer to your thoughts is whether audit committees could be incentivized further to recommend not only one of the biggers for appointment to become the auditor of one company in particular. So with that, I think I've covered in, I hope, less than 10 minutes the topic, but happy to hand over to you again, Patrick.
Thank you, Marjolaine. Are there questions to Marjolaine?
Yes, maybe one.
but we have a microphone for you.
Thank you. Oliver Mann at Southampton Business School. Figures and numbers are lovely.
You can put down your mask. It would be better.
Okay.
Thank you.
We'll try again. Two questions on more numbers and figures, if you have that. Is the market concentration in France increasing, decreasing, or stable over time? And secondly, in reviews of audits performed by regulators, what roughly is the percentage of audits that were deemed inadequate in terms of quality?
Okay, so for the first question, thank you for the questions. For the first question, I would better respond to your question in a few months. We are doing the exercise, and we will have some figures for the comparison. I would see in about 6 months, 7 months from here. So I cannot exactly give you the figures for the tendency of the market in the long term. We will need to see. And your second question was about the rate of findings, or sorry?
Of audits that were reviewed by a regulator or a regulator authority were deemed to be inadequate in terms of quality.
Yeah, for that you have to refer back to the H3C report. You have a certain number of figures in this regard with regard to the rates of it's not inadequate, but the rate of engagement where some findings were identified by the regulator. And I must say I do not have all those figures at hand, but happy to share with you the report, and it's also available online on the website of the H3C.
Professor Sharp.
Thank you. Slide number 9 is very interesting because you have a country between Bulgaria and France, which is Portugal, right?
Yes.
So Portugal, you don't have joint audit there. How do you explain that?
I'm sorry that I cannot answer to this question. I did not look at exactly what the situation in Portugal was. But certainly they do not have a joint audit. So maybe there are some other very good bullets to deconcentrate the market.
Thank you, Marjolaine. Oh, sorry, there's another question over there.
Yeah, maybe an insight on Portugal. There is a large number of PIEs that are specific to the countries. So and small in size, but specific to the country. So maybe an explanation why there is this level of deconcentration.
Thank you. We'll have to dig further and understand better the situation over there. Thank you, Marjolaine. And I invite Professor Manet to come here and
I'll do this lovely thing. Just press the green button.
Yes, exactly.
Okay.
So, please, you published a very interesting study, research on joint audit and audit quality, and we would like to hear the results of your research, and are very happy that you agreed to come to France to make such a presentation. The floor is yours.
Thank you. Thank you so very much. No, the pleasure is all mine. Thank you for the invitation. So I'm here as the academic. So I'm afraid there might be more citations and references in there than you might like. We can skip through those very quickly. I teach corporate governance. I research and investigate corporate governance and audit, the role of audit within corporate governance. And one of the perspectives of my work is on the quality of judgment and decision making and factors that impact on that. Okay, so we're looking at joint audit. Closer. Okay, thank you. So we're looking at joint audit and audit quality, the contribution that joint audit might or might not make on that. And I'm looking at this from a perspective of something called bias and heuristics. That comes from psychology and behavioral economics. That looks at how human beings, and even if we want to dispute that, auditors are still human beings, form their own judgments when it comes to their work. Okay, can you hear me? In my classrooms, I'm usually booming loud enough so 250 students can hear me. Okay, let's go. Very briefly, I think we can agree that the quality of audit has been questioned in the past, is still being questioned, whether audit is performed to a standard that is adequate as expected by stakeholders and society. There are rafts of scandals where auditing or counting irregularities were at least pointed at, and the auditors typically, after a corporate governance scandal, is also being at least pointed at, saying where was the auditor, what was the auditor doing, what is the board of directors doing, of course, as directly involved. Frequently issues of competence and independence and professional skepticism are raised in post-fact investigations. Audit, as we have heard, is providing an assurance, is important for capital markets. It also has a social role, is part of a social contract. We allow audit firms to perform and do these audits for remuneration. But we do also have expectations as to the quality of the work that is performed as part of that contract. Now, audit quality is something we aspire to, but we are not absolutely sure what it means, how to define it, or how to measure it. There are wide disagreements in the public discussion and wide disagreements also within academia of how we actually measure audit quality. And that leads to the issues of judging, say, joint audit or any tool and any procedure that is used in audit to enhance audit quality, how we measure these in terms of providing or adding to audit quality. Looking at empirical investigations, empirical research, the opinions indeed are widely dispersed, quite opposite sometimes, ambiguous results as to whether joint audit contributes to audit quality. Joint audits perform better in certain aspects, whether joint audits cost more. So let's leave it at that. There are disagreements in investigations, also in empirical investigations, and there are ambiguous results. Investigations or summaries of investigations that look at all of the research, or the vast majority of the research that has been conducted on joint audit, come to the opinion that we don't really know how to measure that. We don't really agree on how audit quality is measured or what contribution joint audit might make. Slight changes in the modeling approaches, slight changes in the assumptions underlying the models can change the results quite significantly. The most recent summary of joint audit research that we came across was emailed to us by Patrick just recently, and that comes to very similar conclusions. The empirical investigations don't really guide us towards support or otherwise of any particular tool in audit. Now my question was, well, if we don't really know how to measure that, and if past investigations, the last 40 years of investigations really leave us with less than a firm opinion or of support or otherwise, then maybe we're asking the wrong questions in that research. So my question was, what should be the aim and the objective of implementing a joint audit regime? There was a panel earlier this morning, two gentlemen here who were sitting on audit committees and in companies, and they had a very firm opinion on joint audit, on the benefits of joint audit. They saw how the challenge between auditors and the challenge to management can be beneficial. On that note, just briefly, if I may, it's not on the slides. If a company that is being audited is, let's say, sticking to the rules, does not engage in excessive optimism or earnings management, then the need for audit is actually lesser. If the company is behaving accordingly, if management is behaving according to expectations, then the audit might contribute, but it doesn't, is not as critical. But if there is an issue with the company, either with write-downs or issues with projections, issues with any kind of judgments where management's judgment can differ from that of auditors, then the quality of audit matters much more and the work of the auditor. Okay, so my questions were, what should joint audit actually aim at? What is its purpose? And specifically can joint audit mitigate the impact of bias and heuristics? Now, the bias and heuristics literature, if you're not familiar with that, looks at how individuals form judgments. How do we interpret information? What kind of information do we look at? How do we take that information to either confirm or contradict a belief that we might have on something? That came out of work by Tversky and Kahneman. Tversky is no longer with us. Kahneman got the Nobel Prize for his work on looking at the situation where people make judgments under uncertainty. So we don't know 100%. And of course, audit is at the crossroad of uncertainties. Often in accounting and auditing judgments, we base our interpretations on assumptions, estimates, projections, ambiguity and unpredictability, because we have to make projections into the future. We also take managerial assertions and have to interpret those, whether they are reasonable or not. And what Kahneman and Tversky looked at was simply that individuals, far from being perfectly rational decision makers, and there's a whole raft of literature that looks at that, comes from economics, was very popular in the 80s and 90s and early 2000s until the banking crisis, and it went out of favor a little bit. They said, well, we're not really perfectly rational decision makers, but we use something called heuristics, quick mental shortcuts. There's a huge literature on that. They are efficient, they are quick, they are hardwired into our brains, so it comes from our evolutionary history, if you like, but at times they can lead us horribly astray, and they can do so in a very systematic way. We can make errors, and we don't necessarily notice those errors. We think that we're making good judgments when we really are not. Funny enough, the FRC, which this morning said they're not terribly in support of joint audit, they themselves recognize the impact of heuristics on the quality of decision making when they talk about the work of directors on the board. This is equally applicable to the work of auditors, because we're making judgments under uncertainty as auditors. In many times we just don't know, we make estimates. Okay, so we can sometimes be led astray by these heuristics, and we can make severe and systematic and long-running errors. It affects our information search, it affects the way we interpret information to either support or distract to an opinion. And in very short, on the last line of the slide, poor judgment formation. So that's relying on quick and short mental shortcuts can lead to errors, can bias our judgment, can make poor decision making, and then we go back to number one, and this reinforces ourselves. Okay, I don't have enough time to go into detail on this. It has been applied to the work of single auditor. In the 80s and 90s, that was quite a large stream of research being conducted on how auditors in a single audit team engagement perform their judgment. And are auditors, highly qualified and highly experienced individuals up to senior partner level, are they subject to heuristics? And yes, lo and behold, they were found to be, as anybody else, subject to biases and making use of heuristics that can affect the quality of their judgments, which flows into the quality of the opinion at the end of the day. Okay, so they follow all of these. We don't need to go into detail. All of these typical ways of our judgment formation, which can lead to mistakes, and auditors were simply found to, be as human as the next person, and also make these errors without noticing these. The problem with biases and heuristics is the subconscious. Okay, so any decision we make is affected by these. Even if we don't think we are, even if we think I'm a straight person, I'm a very, very, very rational, and I take all information and weigh it equally. On the whole, no, we don't really do that. So every decision you can assume and you should assume is affected by biases, various cognitive factors. There are ways and means of mitigating against these, i.e. working against these, but these have to be built into your decision-making processes. Now, again, that is also subject. Biases also work on groups, and of course an audit team is a group. You have a senior auditor, you have a partner, you have an audit team, you have an office manager working together, so they form a group, a team. And unfortunately, within groups and teams, you get another set of biases that affect that. So we can get something called groupthink, where suddenly a herd goes towards one direction, even if it's bad for the herd, and it gets reinforced. And even if they're individual concerns, they might go along with that for various reasons. Okay, we leave it at that. Now, very briefly, auditor judgment is affected by heuristics and biases. And often this may lead to a lack of professional skepticism, where they simply assume that managerial assertions can be accepted at the base fact, or that managerial assertions that were accepted last year are still valid this year. And we signed off on the audit last year without any problems. What should be wrong? It's the same management. Okay. The lack of professional skepticism has been highlighted and raised again and again and again. In every review of poor audits, lack of professional skepticism comes out. The FRC is aware of biases and heuristics and how this may skew our decision making and make it poorer. They've put this in an official guidance. It's the guidance on risks on board effectiveness at the very last paragraph here. This is applied to board directors, but it can equally apply to audit and audit teams. At least there's corollaries for that. Some of the wording in that document is mine. I consulted with ICSA when they did the 2011 version of that lovely document. So, professional skepticism for you, I'm sure you are aware of what professional skepticism is, but it's on a spectrum. It can be a very neutral view where you say let's say the financial statements may or may not be containing material misstatements, or you can go to an extreme where you say, let's assume that there's something wrong with it, and let's look for information to convince us otherwise. Forensic auditors go into an audit after the fact, after something has happened, with a presumptive doubt. Actually, they know that something went wrong, and they look specifically for the things that had gone wrong during the audit or within the financial statements. And they have no difficulties in finding that. I find that quite interesting. When a forensic auditing team comes in, give it a few weeks, they will have figured out what went wrong in a seemingly complex fraud or management behavior that wasn't acceptable, when the incumbent auditor found that very difficult to find over years and years and years and years of the engagement. Look at Carillion or Wirecard or Enron or WorldCom, or this morning, and I brought back memories, earlier scandals from the 80s in the UK. When you look at Polypec and the Maxwell scandals, the incumbent auditor being surprised by the things that were revealed. A forensic auditor will have figured that out in 2 weeks. I find that interesting. Okay, right. Just two figures and percentages in here, so not too much. And I'm almost coming to the end of what I wanted to say. Is the FRC in its audit inspection cycle, out of 130 audits inspected, found that nearly 40% were poor and required significant improvements. That's out of 130 audits. The Dutch Authority for the Financial Markets, the AFM, deemed 19 out of 32, that's nearly 60% of inadequate, whatever the definition of inadequate, not good enough. If my students were producing that kind of quality work, they wouldn't be students very longer. If I produced that kind of work, I would be out of a job in 2 weeks. They'd fire me. Anyway, in sum, not enough professional judgment, lack of professional skepticism, insufficient challenge to managerial assertions, or not collecting sufficient or adequate evidence to support the opinion come up again and again and again in these reviews. Okay. Let's skip to joint audit and skepticism. When I started to write some of my research, I looked at whether a key contribution of joint audit could be to audit quality could be from enhanced professional skepticism, more professional judgment, and increasing challenge to managerial assertions. I.e. standing up to management saying, no, you can't do this, or no, this treatment is not adequate, or can't be done, we can't sign it. Okay. There's some work cited below for you for later if you have time or the interest, how some of the characteristics of joint audit might contribute to these better characteristics of a good audit. Some of these points in italics were mentioned this morning. There's a critical mutual review of the audit plan and the procedures and the work of the other team. That is critical to a joint audit. If you don't do that, you don't have a joint audit. You have a shared audit, or you have some kind of split audit, but it's not a joint audit as per the definitions and the French standard and the expectations of what a joint audit should do. You should critically challenge assumptions, assertions and justifications of the other team on top of that of management. So you do a cross review on top of doing that, of course, against managerial assertions. It should, and it does in many instances, if performed properly, encourage a skeptical framework. Skeptical framework that comes from the behavioral issues. When you're looking for a problem, you're more likely to find it than if you're not looking for it. If you're looking simply for confirmation of your prior opinion, then you are disregarding or ignoring information that might stare you in the face. You just don't see it, or you dismiss it, or you misinterpret it, or you give it a different weighting. If you're looking for something that's wrong, you see information in a different light, and you're more likely to spot certain things. Hence, we come down to a forensic audit mindset. At least a little bit of that. You know, I'm not saying you should go into every audit assuming that management are crooks. Okay, even though this might have helped in the audits of Enron and Wirecard, of course, but the vast majority of management, let's assume, are decent folks. Let's assume that. But what if they're not? How can you tell that they're not? That's the issue, because I'm sure most managers, at the top firms that got into this repute were very friendly and very nice and civilized. But the problem is you can trust, and you should trust, but it shouldn't be blind trust when you do an audit. Okay, so this is almost the last slide. So we often you hear proponents of joint audits saying all sorts of lovely things, and I'm not here to say one way or the other. I won't pin you. I'm not telling you. No, I can't tell you. I think it's good for you. But you have two pairs of eyes. You have more diverse teams and more diverse experience. There is a critical mutual review. The emphasis is on critical. Mutual review at the end of it is to say, did we tick all the boxes? Yeah, what good does that do? None whatsoever. Switching tasks so that one audit team then speaks with the other audit team and looks at the areas the other partner did. You also get that retention of client knowledge if you have staggered rotation that was mentioned this morning. So if you have, let's say, a 3-year rule, whatever the rule is, so that they don't have a cliff edge where both auditors just leave and two new come in and you lose all of that experience over time. Empirical research does support some of that. The report that I wrote is available here. If you look at the third paragraph, it's put on SSRN as a research depository, and that goes into some length, as you can imagine, to explain why those positive things might work through a behavioral cognitive perspective. So that looks at specifically at how individuals and groups and human beings make judgments and good judgments, what can affect that, and how might that result and yield into those positive characteristics of a joint audit if it's done properly. Joint audit can go wrong, of course. It's not a magic bullet. It's not guaranteed, but you can see that it has a better chance, if performed with certain objectives in mind, to mitigate against certain biases, hence to lead to better decision making. At least that's an assertion I'm making. Over 60 or 70 pages, however long the document is. It's a bit of I got carried away. I do apologize for that. Okay, and I'm looking at investigating that further. So I'm talking at the moment to audit partners and regulators, and goodness knows anybody who wants to talk to me. So if you had any chance, pop me an email, and I'd love to talk to you for half an hour on Teams about your opinion on joint audit, what works, what does not work so much, how you think it might or might not. I doubt I would be speaking to the German regulator who was here earlier, who was really opposed to it, but it might be an interesting conversation. Maybe he missed something. I know Babington personally. We met at conferences, and he's not completely against joint audit. I wouldn't think so, but he follows a certain agenda, I'm sure. But the German fellow surprised me. Good Lord. I come from Germany myself, so I can get away with saying that. Okay, thank you very much for your patience.
Thank you very much, Oliver. Are there questions to you? Yes, Mr. De Fabiani.
No. Do you make a difference between skepticism
Wait for the microphone.
And my second point is, don't you think that if we benchmark every data, every practice, it would help?
Okay, skepticism and challenge, well, they work together, I think. If you're skeptical, well, if you're not skeptical, you won't challenge. But if you have professional and you apply in a systematic way, professional skepticism, where you don't take managerial assertions or interpretations as a given and simply move on, then you might be likely to challenge. To management. Joint audit also works best if you challenge the assumptions and the procedures of the other team, saying, did the other team actually do a good job? Did the judgment and the opinion they base on their work, is that justified? Your second question was, sorry.
Benchmark every data, every practice.
I presume it would depend on what benchmark you apply.
Yeah, but I can tell you, I was in the oil and gas industry at the time of Enron, and when we benchmarked, Enron was so far away that there was something wrong. But
okay. I think I'm getting what you mean then with benchmarking. That reminds me also a little bit on with regard to the WorldCom scandal. WorldCom was the largest telecommunications company in the United States at the time. Telecommunications, internet, fibers, they were in everything. There were about 4 or 5 competitors on the market in the United States who all, at the end of the dot-com boom, when all the fiber had been laid in the ground and there was nothing else to do and the boom was basically over, they were all suffering problems and falls in revenues or falls in growth. WorldCom said it was not affected by any of that, and it showed figures that were fantastic. Now, to me, not being an auditor per se, and not maybe being an expert of the telecommunications industry by any means, that would raise flags. Then I would say, how come those guys can, when Enron could not explain actually how it makes its business, and had 3,500 special purpose vehicles into which it offloaded its liabilities. A child in the street, I asked my daughter about it, she was at the time 8, and she said, Dad, isn't that something wrong there? She doesn't know what an SPC was, of course not. Okay, but she says, if you have so many things where you're putting all of your assets and your liabilities just to move them off your books, she got that. She said, how do you know the company is actually making money? Or whether the money they claim they're making is real. Okay, and that's where perhaps that is where the benchmarking comes in. So you should, I think that is also called common sense. You step back sometimes and say, let's not look so much at the figures and the standards, but is this actually a story that makes sense when a company spins a story of how successful they are and how wonderful they operate and how much revenue and profits are going to grow? Can that actually be? I mean, maybe it can be. I mean, Tesla finally makes money, and maybe they're proving everybody wrong, and you see Teslas all over the place. But for many years, they were huge in debt, but very little in delivery. Okay, are there any other questions? Oh, of course.
Maybe 2 quick questions. The first one is independent reviews. You do not talk at all about what independent reviews within an audit firm can bring compared to joint audit. My first question. The second question is about accounting principles. Because, you may have a problem with the accounts, but just follow the accounting principles. And the complexity of accounting principles, may make some decisions not that clear, whether you go on one side or not other side. And that's a topic you do not address either.
Maybe not so much on the slides. Okay. Having an independent review depends on who does the reviewing. How independent is the reviewer? If it's within the same firm, you might say, well, yes, we have Chinese walls, we have separation. Those people over there on the review team were not involved in the audit themselves. But how confident are you that a separation within a firm works when colleague has to review another colleague? How critical would they be? And if there's any result or impact on future revenues or the ability to obtain a renewal of the auditing contract, how likely are we going to be highly critical of our own fellow company members? Or whether in a review during the process rather than at the end of the audit on the quality of our procedures that lead us to the audit opinion works better. So an earlier review, I would think, is better than an end of a process review. Your second question? Yes, of course. The accounting principles themselves are, of course, and flexibility, that was mentioned. I mean, accounting standards are flexible. We're not looking at simply counting beans. That would be easy enough if we just looked at inventory and said there's 10 here and there's 20 there, or end of story. As long as we can assess the value, of course, of inventory properly. But accounting standards can be flexibly applied. You would have a company's management who would love to be as flexible as possible. That's called earnings management in a sense. It can be earnings management. The problem, of course, is where the flexibility goes beyond what is acceptable, and who makes the decision of what is acceptable flexibility, and where does that then go into fraud or lying or unacceptable application of standards. So that's where you might have two different diverse cultures or sets of auditors with different skills and different backgrounds and different involvements in the original opinion or individual assessment of certain accounts, where they can maybe able to step back and say, yeah, maybe there is something that is stretching the imagination a bit too much. Let's revisit that and let's review and let's discuss perhaps with management and the audit committee, because management may be the problem. Let's have a talk with the audit committee and try to convince them that maybe it's worth to have another look or to change our mind a little bit. Thank you.
If I may, on this, there was something that caught my eyes in the paper that you shared with me, dated August this year, which was the fact that you based on your work, one of the possible improvements that you see with joint audit would be that the type of joint auditors differ, meaning having a small firm working with a large firm because of the differences potential differences that you see in the personal background of the people, and therefore the different approaches that they may have to the same topics.
Of course, you're quite right to mention that. I mean, there is empirical research that says Big Four and Big Four teams work best or provide better results. Now, I have an issue with the methodologies that are being used to measure these kind of things. I'm not saying these investigations are wrong, but I'm saying they're not as firm or as reliable as we might hope. There is a literature on diversity in group decision making and diversity in teams, and diversity of the individuals that are tasked to make a decision or form judgments or approve certain, let's say, a management plan, a senior executive management plan, and diversity tends to be better. Different diversity, of course, not just gender or background or color of skin, but also, if you like, culture and ways and means of doing things and different perspectives. Because if we're all from one background and have a similar mindset, we might not see a particular issue with a proposal or a project or an interpretation of a standard as it may be, whereas people who come from a different direction or have a different methodology or simply a different, let's say, less averse to being critical, even if it's to individuals who are, literally in power of the organization, that can, under certain circumstances, raise issues or point to problems which would normally be ignored. So teaming a Big Four with a non-Big Four, a challenger firm, what have you, may, under certain circumstances, and that's the devil in detail. Okay, not all teams work best in all circumstances, but if there is a critical problem with a company's accounts, or if they're just being too optimistic, or if they're trying to minimize their exposure to risk. So if there's a critical issue somewhere, a more diverse team with different experiences and different approaches might pick this up and might be able to challenge when a single audit team or a joint team consisting of two teams with a similar background might not pick this up. So that was the long story.
Thank you very much, Oliver. And this was very interesting, and thank you for accepting to come here and have an in-person meeting with us and with the participants to this event.
Oh, thank you.
Something that we really appreciate nowadays.
Oh, so did I. The idea of having one more video conference scared me and didn't appeal. So when I saw a little window of opportunity of actually cutting across the channel, I took it and grabbed it. I think it helps to have in-person conversations rather than video or only video. And after 18 months of this, everybody gets a bit tired. So thank you very much for having me. It's a pleasure.
It was our pleasure.
It's all mine. Thank you.
So we will continue with the last item on the agenda, which is dealing with the input of the representative of the financial markets regulator and the prudential regulator in France. So I welcome Marie Sayer and Emmanuel Rocher to the scene. So Marie is the executive director for corporate accounting at the Autorité des marchés financiers, AMF, the French markets regulator. She has been there for some time now, and before that had spent 7 years with an audit firm as a senior manager before coming to AMF. She is also a representative of the chair of AMF at the board of H3C. So we have occasions to discuss regular meetings. And Emmanuel Rocher joined the Banque de France in 1999, where he was first head of staff to the chair, the governor of the Banque de France. And since April of this year, he has been appointed director of international affairs at ACPR, the banking and insurance supervisor. And he is also the representative of ACPR at the board of H3C. So what we would like to know is the type of relationship, type of interactions that you as regulators have with auditors, and whether there are specificities related to joint audit that you can highlight to the audience today. Maybe ladies first, and I'll give you the floor, Marie.
Okay, thank you very much. So, hello everybody, I'm very glad to be here and to participate to this meeting today. We are the Financial Market Authority, so we work mainly with issuers, but we consider that the relation with the auditors and the regulator of the auditors is key to strengthen the market. So that's really something which is important for us. We mainly work with issuers having two auditors because, as you know, in France, joint audit is required when you have consolidated accounts, and on a regulated market, you have consolidated accounts in case you do have subsidiaries. So mostly all of the issuer, we sort of follow, work with two auditors. So maybe first I will just elaborate a bit on the relation we have between the market regulators, so as IMF and the auditors, according to the regulation in France. So first, there is no provisional secrecy between the auditors and the IMF. So basically, as the market authority, we can ask for all documents we would like, all information from the auditors, and they do have to give it to us. We can have discussion with the auditor, with the issuer, but we can also ask to have bilateral discussions, and that's something they should agree on. And in some cases, the auditors are obliged to inform us in advance on where they are. So the example are, for example, in case of resignation, they should explain us. And when, according to their work, they come to some specific conclusion, for example, there are irregularities, they just tackle, or the issuer do have some issue regarding going concern, so there are some judgment on the conclusion on going concern, or they think they will issue a potential qualified audit opinion, refusal of certification, or express reservation. In all these cases, they should inform us in advance, and basically what we do is that we do have contact with them just to understand and see afterwards if we need to discuss with the issuer also, just to follow the different case which are important for us. So on a day-to-day basis, the way we work is that, as you may imagine, we review the financial information of an issuer. So we do have a work program, and we also review the prospectus. So on all these elements, we do review the accounts. And we do include the auditors in all the process of the review of the accounts. So basically, when we ask questions to the issuer, we also copied the auditors, and we ask specifically the issuers to check the answer he gives to us with the auditors, which explain for us, yes, that the auditors are really important in the sort of environment for us. And afterwards, we always include, of course, as you may imagine, the two auditors in the process, so not only one of them. And afterwards, if needed, as I said, we can ask specific questions. There is one thing which is a bit specific in France, which is named the sort of pre-clearance process, which is basically not done in all European countries and in the world. So basically, it offers the possibility to the issuer to ask us for our conclusion on a specific technical issue before it closes his account. So basically, come with a topic and ask us if we do agree or disagree, and that before closing the account and informing the audit committee. So for us, it's quite important, and we believe it's really important to have this possibility because in that case, the issuer, the auditors, and the regulator has to agree before the accounts are approved on an accounting treatment. And as you may imagine, it's a lot more easier just to decide before than afterwards as regulator, just to come back and say, okay, there's something we do not understand. And we also consider that it's sort of a lot more timely. So it's something we really appreciate, this process. So maybe now if we come to the way we see the audit quality and why the joint audit is important, we really have the impression that because there is two auditors, there are more challenges on the issuer analysis. On the example I just gave you regarding the pre-clearance process, I mean, often when an issuer came is because his auditors do advise him to come, and in most cases is because they do not have the same feeling on the judgments that the issuer might say, and one of the two might consider is a bit pushy and maybe the other one a bit less, and so that's why they just come and said, okay, maybe it's important also to have your view as regulator on what you think on that. So we really have the impression that thanks to this sort of joint audit, it gives more opportunity for us to have this discussion with the issuer and have more challenges on technical issues. I think even more broadly speaking, and not on this pre-clearance process, the issuer, we think, is more challenged by these auditors, because as there is sort of review of the file and both auditors participate to the meeting with the management, with the audit committee and all this sort of thing. I mean, all the key issues are known by the two auditors, and as it was a lot more said by Dr. Marnet, I think it really gives the opportunity to have more challenges and more sort of step back on what makes sense. And I think it's also even more important when we are talking about IFRS, where judgment is key and which are not sort of rule-based but judgment-based standards, and the judgment, as you may imagine, might be different. We also consider that it strengthens the independence of the auditor, and independence, as you know, is really important, because on our market we have more audit firms with sort of large or medium size than in other countries, so it gives less weight to the big four and sort of gives the opportunity to have more audit firm and more, which is more important in terms of rotation on when you have a tender offer, because there are more possibilities. So I think it's important to have this possibility. And the fact also that you have two auditors, as it was said, facilitates the transition when the auditor change, because you might change one of the two auditors, which means that you still have sort of history, because otherwise, if you're talking about a very huge company with a lot of issue, it's quite, I think, difficult to have all the auditors changing at the same time. So basically, in a nutshell, what we can say is that we really think the system, and with this joint audit, strengthens the quality of the audit, which for key is us to have a strength in the financial market. And we think that's even more important when transactions are more and more complex, and where we sort of IFRS, which is judgment-based words. So I think that's it for today.
Thank you, Marie. Very efficient as usual. Emmanuel, please.
Okay, thank you, Patrick. I will try to do my best after Marie, but I just wanted to thank the H3C for inviting ACPR to take part in this event and to give us the opportunity to present our views on the joint audit. So I will now talk about the joint audit in the banking and insurance sectors, which the ACPR is responsible for, and try to draw some lessons learned. So first, as a first remark, I would like to insist on the fact that auditors have a key role to play in building confidence in financial reporting. Audit quality aims at improving the integrity and compliance of financial information provided by the financial institutions. As such, it contributes to the proper information of users, the protection of clients, which is very essential, naturally, and last but not least, to the effectiveness of financial and prudential supervision. So I will elaborate a little bit on that a bit afterwards. So it therefore meets the objectives of financial security and stability. Auditors play an essential role in strengthening confidence and in published financial information, and in ensuring the proper functioning of financial markets. Confidence in financial reporting contributes to the integrity and stability of financial markets, and in some way to the work of the financial banking and insurance supervisors. So as you know, joint audit has been deeply rooted in France. Its introduction in 1966. It has always been presented by the legislators in France as a means to reinforce transparency and financial soundness, as well as reducing the risk of fraud within the largest companies. So it imposes a joint responsibility on each of the auditors, and what is absolutely key for us is that it comprises an independent review. Professor Marnet just spoke about this, but this independent review is actually a key element likely to limit the risk of conflict of interest. And from our experience, this dual review principle is also important in the event, naturally, of difficulties that have to be overcome, and can give comfort to the joint auditors when they question management positions. I would also like to highlight the importance of having effective and adequate interactions between the auditors and the supervisors. These interactions are absolutely essential for the sake of financial stability. This is why we have specific guidance to provide an effective dialogue between the auditors as a whole and the competent authorities in charge of the supervision of the financial sectors. As a result, the interaction between the auditors and ACPR take place within a very formalized framework that is defined both at the international level, because where we have specific guidelines coming from the Basel Committee for Banking Supervision, but also from the IAIS concerning the insurance supervision. But also at the European levels, where we have also to apply specific guidelines from the EBA and EIOPA authorities, and at the national level, naturally. At the national level, for instance, the ACPR has drafted a guide for relations between the auditors and the banking and the institutions. And this guide has been drafted first in 2014 with the help of the body which is representing the industry of auditors in France, which is the CNCC. While all these guidelines naturally do not specifically address the challenges and opportunities of joint audit, they remind us that there's an effective interaction between the external auditor and the supervisors allows for a better mutual understanding of the respective roles and responsibilities, and encourage a regular exchange of information when it's needed. And let's now have a closer look at the interactions between the auditors and ACPR in practice. So as I said, from our experience, joint audit allows for a better understanding and communication with the supervisor. On the banking side in particular, we have in Europe this specific single supervisory mechanism, and within the SSM, there are regular discussions and exchanges between auditors and the joint supervisory teams in charge of the supervision of one specific group. So for the significant institutions that are directly supervised by the SSM. So these discussions take place once a year, and they involve the two auditors in charge of the auditing the significant banking institutions. From our point of view, the interaction with the two auditors allows for a more accurate appreciation of the risk profile of the institution and a richer dialogue on the year-end subjects for attention or on complex issues like these mentioned by Marie previously, such as the credit losses, the estimates, the accounting estimates, and several complex issues. And this is also a key moment to have a look and discuss the prospect for the next half-year statement. Which is important to know is that the discussion with the SSM and the auditors are the subject of an interview with the two auditors at the same time. We also found that in group audit, which is what is very interesting is to know that at least generally the most significant subsidiaries in groups are audited by one of the group auditors and another auditor, which is a key element to provide the College of Auditors of the group with a global view and an adequate visibility on the global operation of the group. And to our understanding, the joint audit have proved to be reliable and efficient in the banking and insurance sectors, demonstrating a complementarity and allowing for a well-balanced distribution of roles between the two auditors, in particular in delivering the messages to the management of the groups. So to conclude, just wanted to insist on the fact that from our own experience as a French supervisor, we consider the joint audit to be reliable, and plays a key role as a safeguard, as an additional safeguard for the financial supervisor in charge of the banking and insurance sectors. Thank you so much.
Thank you very much to Emmanuel and Marie. Are there questions from the audience? Professor Schatt.
And the judge decided that only KPMG was guilty and the small auditor was not guilty. So this was not expected in a joint audit setting. What is your point of view about that? Was the judge mistaken, or do you share this opinion?
I'm not sure I can comment on that. First, I think I'm very glad to know that with Emmanuel, we agree as both regulators that it's important and we're able to have joint audit. And regarding question, I think it's difficult to comment on a specific case, so I can't tell you exactly why it was decided. I think it was quite a long time ago. I was not at IMF at that time, so I I will take the opportunity of that just to say I can't comment, and maybe it will be different today. I mean, don't know.
If I may, I won't be able to comment on the decision from the judge, but one interesting point in the Marionneau case is that the fraud, because it was a fraud in the beginning, was discovered because there were two auditors and they exchanged their controls within the group. So one auditor, when he started to look at the way revenue was recorded, identified a problem that had not been identified by the other auditor. So it shows that nothing is perfect. There was a fraud and it hasn't been identified in the beginning, but thanks to joint audit and to the rotation of the work that is, the areas of work that is done by each joint auditor, it was in the end identified. If I may, thank you very much for the views that you shared. I would like to share a personal comments on this aspect, because I've been a regulator in markets for some time, 14 years. What is obvious is that what the French experience shows is that we've been trying to improve the system over time. When you look back in the beginning, there was this compulsory joint audit, but no guidance on how to share the work between the two auditors. And at some point, the market regulator, it was the predecessor body to the AMF, the Commission des Opérations de Bourse, started to say, hey, we might have a problem there. We need to have something that is balanced between the two. And Professor Marne's paper was also very interesting in underlying that the problem with Denmark was that at the end, because they had no such requirement to have a balanced audit between the two joint auditors, one was doing the job and the other one was just checking the box. And that's not joint audit. And that's the reason probably it didn't bring the quality that was expected by the market, by the clients themselves, etc. And so, to begin with, the market regulator started producing guidance, inviting joint audits to be more balanced. Then H3C was created. H3C also took decisions in this regard. And so now we have guidance that is very clear for auditors in France on the balance that has to be reached between the two auditors. What this experience also shows is that there are things that are in the regulatory framework, like the things that Marie mentioned, which are if an auditor wants to resign and it's a listed company that is audited, then he has to come to the AMF. If there's a going concern issue, he also has the duty to inform the AMF, and they need to inform because there are potential consequences on the market, obviously, but also with the quality of the work done by the entity, which might result in a qualified audit opinion from the joint auditors. This is something that is due to the potential impact on the market, but it has also evolved into the perceived need by the market regulator to identify problems that may occur within listed entities that are put forward by auditors and will need further investigation and further thinking to see how to best deal with this information, in most cases informing the market, but also it evolved into discussions about the way IFRSs are to be applied, because as was mentioned earlier, there is a lot of judgment involved in some questions dealing with the application of IFRSs. And I don't know what is the situation right now. Marie certainly knows better than I do, but in the past we had a number of discussions when new standards were coming into application, and there were many questions from the firms, from their clients, sometimes the firms having disagreement between them and sometimes disagreement with their clients. And I think the fact that it is not written in the law or in the regulation is not a problem. What matters is that the ecosystem evolved in a way that it allows a better quality in the end of the result that is published. If there are no further questions or comments, then I would like to thank you all and ask Mrs. Pebernes to come to the sitting.
Dear members of the Parliament, ladies and gentlemen, on behalf of H3C, I would like to thank you all for your participation in this important event on joint audit. Many thanks for our colleagues from South Africa and Bulgaria who have shown us that joint audit doesn't mean that one size should fit all. I am very thankful for to all participants who have shared their experience and expertise during this day, and would like to thank warmly Professor Marnet to all his work on joint audit, which shows that joint audit is contributing to better audit quality. An audit supervisor is the key individual focusing on audit quality. The mission of a supervisor is checking the quality of audits and sanctioning when insufficient audit quality is met. However, audit supervisors are also very much interested in the state of the audit market in their jurisdiction. At European Union level, the Commission acknowledge that concentration of the audit market is a matter of concern. In France, audit concentration is less important than in other EU countries, as has been explained today. Joint audit certainly played an important role in achieving this result. And we have to acknowledge that concentration is at play in our market, which means that there is not just one solution to the problem. It is also a matter to willingness from tier market participants to resist offers from the largest networks. We can see increasing use of artificial intelligence tools by auditors and the very significant investments these tools require, but we need to preserve alternatives. We are very much enjoyed hosting the event here at the Palais Brongniart and also online, and I'd like to emphasize that today should be viewed as a beginning, not an end of the discussions. So thank you very much for coming, and goodbye.